Wow, yours is nice, huh? You have a background of our class. What's that? Is that the monitor?
I actually this one my almari.
Almari. Oh, you mean the mirror?
Yeah.
Oh, okay. No wonder I can see. All right, good. Now, just a recap what we have covered last week. Huh? So we have covered non-current asset, accounting for non-current asset. So remember, non-current asset is an item that is bought for the purpose to be used in the operation of the business. So we need to, charge part of the cost as an expenses. So which is, we call it depreciation. Okay, why we have to do so? The reason being, because it doesn't last forever. The item doesn't last forever. It diminish in value. Okay, decrease in value. So we have to reflect that into our financial statement because we are observing, the prudence concept. We do not want to overvalue the asset. So, but bear in mind, this is an expenses which is not actually paid. So we just do allocation. So that's why what we need to remember, every year we have every year or every month we have to provide the depreciation. So how do we provide? Is repeating. Okay, that is just for for simple memorization. So we have to remember depreciation is an expensive. Oh, I forgot to record it. So let me do the recording first. So we have to provide the expenses every month or every year. It depends. Depending on the policy of the company. Okay. So when we provide, we just remember depreciation is an expenses, but it is not actually paid. So we debit depreciation. Where do we credit? If there is a debit, there must be a credit. So the credit is we accumulate. Yeah, we accumulate the depreciation that we have charged as an expenses. So meaning it will be in the accumulated depreciation account. That's how we remember. Now, as we provide depreciation because an expenses, it reduces the profit, isn't it? Okay. So, and also it reduces the accumulated depreciation because from time to time we have to carry forward to the next following year. And for accumulated depreciation, okay, we use liability concept. So it should be together with liability, but since it is related with the asset, so we are presenting it in the asset side. But make sure you must put the negative value, so minus. Okay, so that's what we learned. So depreciation is an expenses, so it should be in SPL. Yeah, so debit SPL, but debit means less. Okay, it is because we are preparing statement profit or loss in the statement form. So meaning debit is minus. Okay, where is the credit? So credit is when we allocate into accumulated depreciation as a liability. Okay, but then it will be presented together with the asset. So you need to minus the non-current asset. So that's it. That's what we learned. So that will be in the SOFP. Okay. Any question before we proceed to the next chapter? Kevin, do you have any question?
Oh, no.
No.
No. No.
No.
So are you ready for the test this coming Friday?
Oh, still practicing.
Right.
I
Okay.
don't think I can. I still don't think I can finish in time right now. I still need
Why
to
why
prac-
not?
Oh, no, I just said this the team time consuming in Excel.
Oh, okay. But I did brief you what will be coming out, isn't it?
Yeah. I just afraid I do too slow. The thing.
Oh, then you have to practice so that your speed will increase.
Okay.
Okay, wait, let me check. Just what do you call it? Let me brief you again. What will be coming up? So you'll be asked journal entry. Okay, you'll be given a few what do you call it scenario, and then you determine what will be the journal entry for that particular transaction. Okay, so there are three scenario. Then you have to do the journal entry. Okay, then you need, okay, you're given a table, so you have to determine the effect of the transaction. Okay, you're given a transaction and you need to identify which are the key account, the key ledger. Then you determine, you classify them. Is it an asset, liability, or capital? Then you have to determine whether the effect increases or decreases. Okay. Then you'll be given you need to do cash book, 3-column cash book. So given a transaction and you do the ledger, the ledger, or sorry, the prime entry for cash book. So using 3-column. So debit side, we have discount allowed, bank, and cash column. And then on the credit side, so discount received, bank, and cash column. Okay, you record it correctly. So just remember, deposit that is increasing either cash or bank will be on the debit side. So same goes with the discount allowed, because discount allowed is an expenses, isn't it? It's a debit item. So it will be on the debit side. But for credit side, so this is payment. Okay, payment by check, by cash, and then discount received is an income, so it's a credit item. Okay, and then a few theory. Okay, probably you need to explain all the prime entry. So read on all the prime entry, and then find a few examples of all these the 5 category that we have. We have asset, equity, liability, revenue, expenses. Okay, look for examples. Yeah, that's all. Very simple. So 1.5 hour. Okay. All right. So back to the topic today.
Oh yeah, sir, how many questions altogether?
How many questions? Actually, the question, they a lot. There are 3 questions only. Sorry, 2 questions only. But then the 2 question is all like we have sub question. Like question 1, we have uh, 5 sub question that include. Oh, sorry, 5 sub question, and then question 2. That one is for cash book, But then you have sub-question, theory part. So 5 as well.
Okay.
Okay. Okay, so next thing is accounting for trade receivables. So remember, trade receivable is an asset as well. Yeah, so an asset, just like the non-current asset, but it's just that this one we have two parts, different part. Like for depreciation, we provide the expenses every year, every month. So same goes with trade receivable, but that is the second part. So the first part is bad debts. So we're gonna go through all of this accounting treatment. So first thing, what you need to remember, trade receivable. You must understand what is trade receivable. So trade receivable is the customer who buys the trading item on credit. So when I say trading item, so this one related with the main trading business. Okay, let's say we are talking about hardware. So the hardware items are those trading items. So any customer that buying the hardware item on credit, that will be considered as trade receivable. So if it's other than the hardware, so that will be known as other receivable. Okay, so trade receivable is an asset, and we have the possibility of the risk that we have in selling on credit will be bad debts. So bad debts, look at the word bad. Bad means the debtors, the receivable, okay, unable to make payment. So it is being written off. The amount will be written off from the books. So that is known as bad debts. Charge it up as an expenses. Okay, so meaning if we charge it out as an expenses, we provide bad debts in the accounts. So again, this is an expenses, so it will be debit item. And then bad debts recovered. So what does it mean? Meaning it was initially declared or written off as bad debts, unable to make payment to the business. But later years, this trade receivable came back and then make payment. So this is known as recovered. Okay. So since receiving money, okay, the business receiving money, it will be debited into the bank and then credited to the bad debts recovered. So bad debts recovered is the opposite than bad debts. So this is revenue. Okay, just remember opposite. And the fourth one, okay, we need to know or we need to provide doubtful debts. Okay, doubtful debts, meaning this is an estimate of debts would not be collected by the business. So this is not actual expenses, like what I've said to you, depreciation. It's not actual expenses that is being paid, but it's just an estimate. So we provide as an expenses in the business, okay, in observation of the accounting concept that is prudence. Okay, remember, like what we said just now, we are consistent. So asset, trade receivable is an asset. So we do not overvalue the asset, the trade receivable. So that is why, in order to be prudent, in order to observe the prudence concept, we have to estimate an allowance of doubtful debts, okay, to reduce the trade receivable. Because the trade receivable, we have the risk of not able to collect the money. Okay, so that's why we do not want to overstate the value of trade receivable. Okay, and charge or charge out. So meaning, what is the meaning of this charge out? Means we do accounting treatment that is as an expenses. Okay, so the effect is reducing the profit. So like what we have in chapter 6, yeah, non-current asset. So 10% charge out depreciation. So this is not actual expenses. What I mean not actual expenses, meaning there's no cash involvement. We don't have to pay the depreciation, or we don't have to pay the doubtful debts. But we provide it. So meaning it will not involve bank. So that's why we have credited account, like depreciation, we name it, we term it as accumulated depreciation. But for doubtful debts, we name it or we term it as allowance of doubtful debts. Okay. So unlike electricity, okay, is actual payment and it is 100% charge out as you consume, isn't it? So it's different concept, but same treatment. Now, like what I've explained to you, trade receivable. So any item, any trading item that is sold to the customer on credit terms. When we say credit terms, meaning the payment of that sales, okay, will be postponed later, probably 30 days later. It depends on the credit terms given to the customer. So business can sell the product on credit or on cash term. Nevertheless, most of the sales are on credit terms because this will encourage more sales and decreases the risk dealing with large amount of cash. So that is the reason why we must have a credit sales. One of the reason is to encourage more sales from the customer, and then avoid to deal with large amount of cash. Okay, it's dangerous to use in cash term
Right.
because it's subject to manipulation, and also you have a lot of risks attached with it. Okay, so therefore we have credit terms. So there will be customer. So those customer that is buying on credit will be known as trade receivable. Okay, last time it was known as trade debtors. So we're no longer using trade debtors because that is an old term. So the new term is trade receivables. Okay, so other customer that buys the non-trading item on credit, that will be known as other receivable. So it's not the same. Huh? So trade receivable is the current asset item. Okay, current asset item. So meaning when you present in the statement of profit or loss, it should be under current asset. So it will be listed after the inventory, closing inventory followed by trade receivables. Now this is the flow. We need a source document, and from the source document, we can identify. So this goes to which book of prime entry. So since this one not involving cash, yeah, so it's not cash book. And again, it depends. So this one is if it's bad debts, then it's involved the trade receivables. So what is the source document that will be used? It will be the memo from the management. So same like depreciation. So memo regarding bad debts and allowance for doubtful debts. So we record, so we use general journal as a prime entry. Then from the general journal, we do the posting from general ledger. So when we do the posting in the general ledger, so the point of reference, we always look at the general journal. Okay, so that is the basic concept of how we do the recording. Now, let's go through what is bad debts. So bad debts meaning is a confirmed debts that cannot be collected after so long time, then it will be known as bad debts. Okay, so meaning we have used all other method how to collect it. Gave him the letter of demand from the lawyers, also still not paying, or either we visit the client's premise, they are not paying. So meaning if it's confirmed, so probably because of the reasoning, because he become a bankrupt person, so meaning is confirmed. So if it's confirmed, cannot be collected. So as an account, as a management in the business, so we need to decide to write it off. Write it off meaning we have to take it out from the books. Okay, so in order to write it off, so we have to treat as an expenses. So an expenses meaning we need to record on the debit side. But what is the term that we call it? So we call it bad debts. Okay, so remember the effect. When we provide as an expenses, this will reduce both. Okay, the trade receivable and the profit amount for that year. Okay, how can it be? It reduces both the trade receivable and profit amount for that year. So meaning this is showing how we record. So when we provide as an expenses, so remember, we are using matching concept, isn't it? So revenue, you less with the expenses, which is one of them is bad debts. So that is the meaning, reduce the profit. What about reduce the trade receivable? Reduce the trade receivable, meaning it will be written off and credited, it will be credited in the trade receivable. When we write off, meaning we have to cancel it from the trade receivable amount. So that is why we debit bad debts. Look at this. We debit bad debts and we credit trade receivable. So remember, trade receivable is an asset, isn't it? So when we do a credit entry, we are writing off that amount from the account. So we credit trade receivable. Can you understand? Okay, that is the meaning. This will reduce both the trade receivable and profit amount for the year. So from time to time, the question in the exam, they will ask you to explain in wordings. Okay, what is the effect? So this is how you explain. Okay, the entry. We debit trade receivable. Sorry, we debit bad debts and we credit trade receivable. That is to reduce the trade receivable and reduce the profit because we are charging the bad debts as an expenses. So a bad debts is a normal business expenses. So it is important to note that bad debts is a known amount from someone specific, meaning this is what we call specific amount that is being written off from his account. Okay, so this is not an estimate. So meaning it's confirmed already. Can you understand? Okay, the double entry. So this one you have to remember. How do you remember? Bad debts is an expenses, so you debit bad debts. And then trade receivable is an asset, so you have to reduce the trade receivable, so you credit trade receivable. So that is the explanation. Why debit bad debts? Why credit trade receivable? Can you understand what I'm saying? Why we debit bad debts? Farah, what do you think?
I'm not sure.
Huh? You're not sure? Because bad debts is an expenses. That's why we debit bad debts. Why we credit trade receivable? Noel.
Because it is an asset item, so we need to reduce it. So
Yes,
credit.
we need to reduce the asset, because it's confirmed that asset not collectible. So we have to reduce the trade receivable. So by knowing the reasoning, you can automatically understand the double entry. Okay, so let's look at the illustration here. Mr. Trouble was declared a bankrupt on 31st of December, and his total debts amounting to 5,000 is to be written off as a bad debts. Now, before that, so you need to know, when Mr. Trouble was buying the goods on credit, we already done the recording, isn't it? That is, we have debited trade receivable, okay, this one, as an opening balance here. So we have debited, and then we have credited the sales, already done. So that's why we don't have the sales account here, because this is an extract. Extract meaning we're only showing the part that we want to explain. So that's why you have an opening balance here. Balance brought down, opening balance. Okay, 5,000. Can you understand? And we have done a lot of effort to collect this money from Mr. Trouble. But Mr. Trouble never paid until it is confirmed he's been bankrupt. So now we have to write it off. So in order to write it off, so we have to reduce. Okay, that's why we credit, okay, trade receivable, Mr. Trouble here, 5,000. And if there is a credit, there must be a debit. So the debit will be bad debts account, 5,000. And the particular trade receivable control account. Okay, but remember, since this is involving trade receivable, so just like the sales journal, we have to do 2-step, correct? 2-step. So we don't record into the sales journal because it's not involving credit sales. We don't record into return inward journal because it's not written inward. But it's just that this one cannot be collected. So that's why the prime entry is not sales journal. Okay, because it's not credit sales. It's not written inward either. So that's why we don't use that prime entry. So the prime entry that we're going to use is the general journal. So general journal, okay, using the same concept as journal entry, like this one. Okay, we debit bad debts, we credit trade receivable. Look at the date. The date must be the last day of the accounting period. So we debit bad debts 5,000 and trade receivable 5,000. So this is your point of reference. Okay, first thing, you need to do single entry in the sales ledger. Okay, first step, sales ledger. So meaning, remember sales ledger, we have individual account trade receivable, isn't it? So we only do credit entry, 5,000 here. And a particular bad debts, but no debit entry yet. Can you understand? Then the second part, the second step, okay, as what I've said to you, the general journal is your point of reference. So open up bad debts account and open up trade receivable control account. And in the trade receivable control account, the same goes with a trade receivable control account. We already have the opening balance here. So we have balance brought down, but then we did not show it because this trade receivable control account is not the same as individual trade receivable, because trade receivable control account containing multiple individual. So probably it's not 5,000. It could be 500,000. Yeah. So that's why we did not show here, but we just showing the double entry. We debit bad debts 5,000. We credit trade receivable control account, because this is general ledger, the main ledger. Now, can you understand?
Okay.
Kelvin?
Okay.
You sure, huh? All right. What about you, Farah?
Yeah. Okay.
Okay. Okay. The most important thing is you need to understand. Okay, bad debts is an expenses, so that's why the 5,000 is on the debit side. And then trade receivable control account, the 5,000 will be on the credit side. And in the bad debts account, the particular must be trade receivable control account. Okay, meaning the heading of the account that is being credited. And in a trade receivable control account, the name, the particular will be bad debts, because this is referring to the name of account that is being debited. And the date must be the last day of the year. Then the bad debts, okay, like what I've said to you, is an expenses. So we have to close off by putting this line. Okay, it must be in the same row, and the particular in the bad debts account you put as SPL. Unlike control account, we have balance CD, balance BD, is an asset. Okay, in the financial statement, so this is an extract statement, profit or loss for the year ended. So we complete the double entry of the bad debts account. Okay, so we close off the bad debts, and then by crediting, so we debit in SPL, but debit, okay, because we are preparing in the statement form, so debit is represented as less. And we put on the second column, okay, because the second column is where we we do the listing for all the type of expenses. Okay, after we completed the list, then the total amount we move on to the third column. Okay, that is bad debts. So next one is bad debts recovered. So bad debts recovered, okay, the word itself, recovered, meaning initially it was written off as bad debts, but later years, so the trade receivable came back and then make payment. So that is bad debts recovered. So debts written off in previous year, recovered in later years. So it was an expenses before that reduces the profit for the year. But then when he came back and recovered it later, so this will be treated as an income, a revenue. So that is why, okay, because, okay, that explains why we debit cash, why we debit bank. Okay, because as the business receive, if it's in a cash basis, then it will be debited cash. But if the business receive in check form, then it will be debited to the bank. Okay, so if there is a debit, there must be a credit. So the credit will be the income account. So that explain here. So expenses, at first expenses, but now an income. So bad debts, we term it as bad debts recovered. So this is ideal term. So bad debts recovered as income. Then we credit. So credit item, income, revenue. Then the narrative or the explanation underneath. So the bottom part you put bad debts recovered. Okay, please note that we do not debit the trade receivable account, and this account would have been closed when the debt was written off previously. Okay, why we don't the trade receivable involved here? Because we already closed off the trade receivable, isn't it? With the bad debts. So that's why it's not involved. So what involved here is receiving money, and then create the revenue account. Okay, you have this illustration on 31st of December. Debts 8,000 written off in previous year were recovered. So we don't do like just now, two-step. So it doesn't involve sales ledger anymore. Immediately to the general ledger. Okay. In general ledger, because we have the prime entry only, the prime entry is the cash book. So we debit the bank, okay, and the particular you put as bad debts recovered, meaning you have to open up a general ledger account. So you just name it as bad debts account. So you don't have to write all this. This one is only explaining to you. Okay, so you just write down bad debt recovered account. So this one only telling you, so this is an income. So rental income. Unnamed person. We don't put any individual names. We don't have to. So we put it as general bad debts recovered. So meaning any, let's say if this bad debts recovered consists of different individual, we can combine them into one account. So let's say we have bad debts recovered from A, B, C, D. So we have to list down individually. A, how much? Okay, B, how much? You just write it down as bank lah. Yeah, the name is bank. Okay. I mean the particular we write down as bank. Then credit sales method of recording income. We debit trade receivable 5,000 and credit bad debts. This is I don't recommend this one. Okay, this one is an alternative ways how to do, but too long. You know, end up, you see, this is debit cash, credit, bad debts recovered, isn't it? So ignore this one. Okay, by right, just for knowledge sake. So first thing, okay, we are reinstating that amount. So we debit the trade receivable, Mr. Trouble. And then by debiting trade receivable because this is an asset, so we increase. So we increase the trade receivable and asset, and then we credit bad debts recovered. And when we receive the cash, or whether it's in the check form, so we debit bank 5,000, and then we credit the trade receivable. So we are closing the individual account of Mr. Trouble. So we have, you see, debit trade receivable, we credit trade receivable. So we close the account, isn't it? Okay, so this is a long method. Now, financial statement. So in the financial statement in extract form, so we show it in the statement profit or loss. So remember, this one we have to close this account because this is revenue, income account. So by putting the particular here SPL and putting the 8,000 on the credit side. So this is we close off. We close off. So this one we are closing off also. So no more revenue to be carried forward to the next following year. Instead, we debit the bad debts recovered and we credit SPL. But then, like what I've said to you, okay, since we are presenting the SPL in the statement form, so we don't see debit and credit. So credit is represented as add. So add income, so bad debt recovered. Again, we put into the second column. Why? because the second column is to do the listing of all the revenue type or the income type. Once we have completed the list, then we total it. So the total amount, then we move on to the third column, okay, to be added with the gross profit. Okay, that is bad debts recovered. Any question on bad debts recovered?
But the
Okay, bad
recovered
debts.
count as income.
Yes, bad debts recovered is an income item, so that's why it's on the credit side. Remember, income is a credit item. Okay, that's how we remember. And if that is credit, so there must be a debit. So since the business are receiving money, so we debit either cash or the bank. But bad debts is different. Bad debts is an expenses. Just now is bad debts recovered. So we debit bad debts, we credit trade receivable. So different treatment, because bad debts is an expenses, but bad debts recovered is a revenue. Okay. Now, the next thing is allowance for doubtful debts. Now, allowance for doubtful debts, okay, it is known fact in business that not all the debts can be collected. Business can use different method and measure to collect the debts, but there will be some customer who just won't pay up, either because of financial difficulty or bad faith. Okay, meaning as the business is selling on credit to encourage more sales, okay, there is a risk of not getting back the money. Okay, the trade receivable not paying the amount they owing to the business. So that's why we are following the recommendation by the prudence concept. So we do not overstate the asset. So since trade receivable is an asset, so we do not overstate. That's why we are providing the allowance for doubtful debts. Okay. So normally, the percentage of debts are not collectible varies from business to business. So we have this percentage. So the percentage is based on previous year's experience. So business can estimate how much of the debts that cannot be collected. So at your level now, you are not, you are not required to identify how much is the percentage, but you'll be given the percentage. So just for information's sake, how do you get the percentage? Okay, normally they must have the historical data. So if let's say from previous year they have total trade receivable 100,000, and out of this 100,000, probably 1,000 unable to make payment. So they use that figure. So 1,000 divide with 10,000 times 100%. So they have the percentage 10%. So that is previous experience. So they use that percentage, okay, to provide this allowance for doubtful debts. Okay, but in your case, you'll be given the percentage. So you just apply the percentage and then times with the trade receivable. So this is called doubtful debts. Okay, a business is estimating how much of the total debts cannot be collected. Estimate. Estimate means it's not actually happened, but we just make an estimate. So meaning no cash involved, no payment. Okay. So meaning if we provide as an expenses, so we need, that is debit, isn't it? We need a credit also. So what will be the credited account are known as allowance of doubtful debts. What is the expenses terms for this? Doubtful debts. Okay. So we have allowance for doubtful debts and doubtful debts. Thus, we have allowance for doubtful debts. Huh? So since the amount is not specific, doubtful debts are categorized as an allowance. Thus, we have allowance for doubtful debts. So please note the allowance for doubtful debts is calculated after deducting bad debts. So meaning you have to identify whether the bad debts that is being written off already been recorded in the trade receivable. If not, you need to record first, then the net after the bad debts you apply with the percentage. Like what we have here. Trade receivable, 100,000. So this is bad debts, confirmed debts, not able to be paid. The name of the customer is ABC's number, so 10,000. So only 90,000. Okay. So 90,000, then less allowance for doubtful debts, 5%. Okay. An estimate. So how do we get 4,005? So since you are given the percentage here, 5%. So 5%, okay, 0.05 you times with net 90,000 after the trade debt, bad debts. So 90,000. So you get 4,005. That's how you get, huh? So 5% you times with 90,000, you get 4,005. So in SOFP, when you show, so the amount will be 85,500 in SOFP. SOFP meaning Statement of Financial Position. Okay, so we take the net trade receivable, 85,500. So this is in observation or in line with the prudence concept. So trade receivable is an asset. So we do not overstate the value of the asset because we know trade receivable, you have the risk of not collecting. Not 100% can be collected. So part of it, probably 5%, will not be collected. So we reduce the trade receivable, okay, in line with the prudence concept, to 85,500 by providing allowance for doubtful debts. Okay, so when we provide allowance for doubtful debts, so we can, this will happen, changes in allowance. Okay, so changes in allowance we record in SPL. Okay, changes compared to last year. Okay, what is changes in allowance? This is change compared to last year. So previous year we have the allowance, okay, and then compare with the current year allowance. So if the current year allowance higher than the previous year, so meaning you will have increase in allowance. But if it's the opposite, okay, if the previous year higher than the current, then it will be decreases. Okay, so if it's increase, expenses. If it's decreases, it will be considered as income, so credit. Okay, you will see this later, but this is an explanation in theory part. Huh? Okay, change compared to last year allowance. So if there will be increase and decrease. So if it's decrease, it will be recorded as an income. So it will be credited. Okay. But if it's this is the explanation for income. Huh? If it decreases down, then it will be credited. If it increases up, then it will be debited. Now, similar to bad debts, an allowance of doubtful debts is an expenses that reduces both the trade receivable and profit amount. Okay, so what does it mean? Meaning, okay, the doubtful debts, okay, it reduces the profit because doubtful debts is an expenses. And allowance for doubtful debts decreases the trade receivable because, like what we have here, okay, the trade receivable 90,000 we minus with allowance for doubtful debts decreases. So that is the meaning. Okay, allowance for doubtful debts is an expenses that reduces both the trade receivable and profit amount. We note from the example above that even though we have customer owing us 100,000, the net amount of trade receivable after adjusting for bad debts is and allowance for doubtful debts is only 85,000. So is it acceptable to you? What do you think? You think it's not fair? Then we are observing the prudence concept. So this is in line with prudence concept, stating assets should not be overstated, like what I've explained to you. So we do not overstate the trade receivable. Even though we have made 100,000 sales, but we can expect to collect only 85,500. We should not show the trade receivable at 100,000 in our account. If we do so, we are overstating our asset. And this mislead users into thinking that we have 100,000 of asset in our books, whereas only 85,500 are collectible. So we do not want to give a wrong picture to the users of the account. So that explains why we have to learn this concept, why we need to provide this concept. Yeah. So let's go through the illustration. Now, allowance for doubtful debts. So this is the first time. The objective, remember, to estimate amount owing by certain customer who unable to settle the debts. So it's different from bad debts. Bad debts is confirmed, but this one is an estimate only. Okay. Let's say on 31st of December, Mr. Sad decided at the end of the year to make an allowance for doubtful debts of 5% on the outstanding trade receivable, 250,000. So this is the first time Mr. Syed is making Mr. Sad, yeah, making an allowance for doubtful debts. First time. So remember, this is the policy of the business, 5%. So how they created this? They have looked at the previous experience, okay, and then they managed to get this percentage. So 5% of 250,000 is equivalent to 12,500. Now, at this point, because this is the first time, so we don't have the previous allowance. So meaning this is considered as increase because the previous allowance is zero, isn't it? We assume it's zero. And the current year is now 12,500. So this is an increase, isn't it? Okay. So increase, like what you are given in the notes, if it's increase, it will be an expenses. So that's why we debit doubtful debts expenses, 12,500. And we credit allowance for doubtful debts. Okay, you don't have to write this bracket here. This bracket is only giving you the explanation. Same goes with this one, expenses. You don't need to write this down. Huh? This is only explaining to you. Okay, what you have to write? Only doubtful debts. And then allowance for doubtful debts. So that is the concept. Doubtful debts, how to remember? Just like depreciation. You just remember this is an expenses. So you debit the expenses account, which is doubtful debts. And what do you credit? If there is a debit, there must be a credit. So this is allowance. Allowance is a peruntukan. In Malay, is peruntukan. So meaning we just create an account and make that as an allowance account. So allowance of what? Doubtful debts. Okay? Allowance for doubtful debts. That is the concept. So how do you calculate? So take that percentage, you times with the net after the bad debts. So you have to determine whether the trade receivable they already recorded or not. Okay, the bad debts. So we times 250,000, so 12,500 first year, and then we credit allowance for doubtful debts 12,500. Okay, this is explanation only, similar to liability account. Okay, provision, estimate, actual amount not shown. So you remember, this is not actual expenses, so that's why we don't credit. Hey, so, but we still have to find what is the credited account. So we, use it as a liability concept. Okay, we name it as allowance for doubtful debts, not being paid yet, but we just provide allowance, isn't it? Okay, so using liability concept, but then when we record in the SOFP, again, it is related with trade receivable. So when we do the presentation, we attach together with the trade receivable, but only the symbol we change to negative, just like depreciation, accumulated depreciation. Okay, so related with non-current asset, so we put together with non-current asset, but we minus. Now the narrative, this is the explanation, allowance for doubtful debts for the year. Okay, 12,005, 12,005. Then use this prime entry, the general journal, as a point of reference when we do the double entry in the general ledger. Okay, so this one doesn't involve the sales ledger because this is in general. So we record in the general ledger, open up allowance for doubtful debts, and then open up doubtful debts account. Okay, this is the heading, allowance of doubtful debts account. And then this one is doubtful debts account. So that is the heading. SOFP and SPL is only an explanation. So this is liability account will be recorded in SOFP. And then this one is an expenses account. It will be recorded in SPL. So you cannot see balance CD or balance BD. Balance CD for income and expenses can be used to close a T account in the middle of the year. This one is telling you if it's not at the end of the year yet, okay, that is probably the company wants to do on monthly basis or half yearly, okay, then at the end of the year, then they do the real closing. They can put the terms balance CD and balance BD. But then if it's at the end of the year, you don't use balance CD or balance BD. So immediately you put SPL like this one. Okay. So now let me explain to you. So just follow this entry. We debit doubtful debts. So this is doubtful debts. We debit 12,500. So this is 12,500. It was debited. Okay. Put on the debit side of doubtful debts. And then put the credit side in doubtful debts. Allowance for doubtful debts. Okay. And then in allowance for doubtful debts, the particular, this one, okay, you put doubtful debts. Particular here, you put doubtful debts. And in doubtful debts account, the particular AFDD. AFDD stand for allowance for doubtful debts. Okay. Then, since this is SOFP, yeah, item, so meaning we have to carry forward the balance. So that's why we put balance CD above the total, and then balance BD below the total on the credit side. So this is credit balance. Whereas doubtful debts is an expenses. So SPL item. So we have to close off. Close off, okay, by transferring or posting this amount into SPL by crediting doubtful debts, and we debit SPL. Okay, but then you see the allowance of doubtful debt as we provide at the end of the year, it doesn't affect the trade receivable control account. It's still the same, isn't it? It's different from bad debts. Bad debts, of course, is a actual amount, so not an estimated amount. So we have to write it off from the trade receivables. Now, in the financial statement, so like what I've said to you, we complete the double entry, but you don't see debit and credit because we are preparing in the statement form. So that's why when we do debit in SPL, okay, we put less, represented as less. Okay. So you put into the second column, But this one they put into the first column. Never mind. But normally it will be in the second column. Now in SOFP, statement of financial position extract. So it should be under current asset. So first thing, you have to list down the trade receivable. Okay, that is from the general ledger, 250,000. Okay, and then allowance for doubtful debts. So allowance for doubtful debts supposed to be using liability concept, isn't it? Like what I've told you. But since it is related with trade receivable, so we present together with the trade receivable, but the symbol. We change the symbol, not positive, but it should be less because this is supposed to be together with the liability. So you minus 12,500. So this is the net amount of the trade receivable. So what is doubtful debts? What is an allowance for doubtful debts? Are they the same? They are not the same. Huh? So doubtful debts is an expenses and it will be closed off to SPL. Whereas allowance for doubtful debts is using liability concept. So meaning it will be presented in SOFP. Okay. So another illustration that is again increase in allowance for doubtful debts, but then just now was first time. So this one you already have existing year. Okay, so you need to find what was the previous allowance of doubtful debts. Let's say we continue with the same illustration. On 31st of December 2016, the following year, Mr. Sad decided to increase the allowance for doubtful debts to 14,000. Okay, 14,000. Initially, how much was it? Initially was how much?
12,500.
Okay, 12,500. So that is the opening balance of allowance for doubtful debts. And now, as your trade receivable closing balance 280,000 increased from previous year. Okay, 280,000. Last year, previous year, okay, only 85,500. But now is already 280,000. Sorry, different. Last time was 250,000. Now is 280,000. Increase of 30,000. Yeah. So 5%, 0.05 times 280,000. So you have 14,000. Okay, that is the new allowance. So allowance for doubtful debts account always has credit opening balance. So remember that allowance for doubtful debts, like what I've said, using liability concept. So when you record in allowance for doubtful debts, okay, so you put as balance BD, okay. So you only record this one in the particular. The rest is only giving you the explanation. So 2016, so this is your opening balance, balance BD, 12,500. Okay. So first thing, what you do, because you already have the information, okay, that is opening balance and closing balance from here. On 31st of December, the following year, decided to increase the allowance of doubtful debts to 14,000. So meaning this is your closing balance. And the opening balance from last year is 12,500. So this is your opening balance. So, I mean, we have learned. So liability concept will have opening and closing credit, isn't it? So opening credit, meaning balance BD will be on the credit side. Closing, yeah, credit, okay, balance BD above the total will be on the debit side. And BD, the opposite, yeah, below the total on the credit side. So then put all this value, okay? So this is what we calculated just now, 5% of 280,000. So we record, okay, 14,000. Then record 14,000. That is the first thing that we need to do. Okay, opening, we already recorded. Closing, also we already recorded. Then we can put this total column, single line above and underneath double line. So check which one is the highest value, 12,500 and 14,000. So 14,000 is higher, isn't it? So we use 14,000 as a total for both sides. 14,000 on the debit side, 14,000 on the credit side. Then, in order to make the total credit as 14,000, we need balancing figure 1,005, isn't it? So that 1,005, okay, the particular we write down as doubtful debts as a balancing figure. This is balancing figure, balancing figure. So this balancing figure will be posted to none other than the other two related account, doubtful debts. So we put doubtful debts. So doubtful debts, we put here 1,000. We complete the double entry 1,200. Sorry, 1,500. And the particular, okay, in allowance for doubtful debts, you put doubtful debts. And in doubtful debts, the particular, you put allowance for doubtful debts. So that's the technique. Okay. First thing, you record the opening balance. Okay, opening balance meaning referring to the previous allowance for doubtful debts. So we put on the credit side. And then in the question also, they provide you the current year provision. So use that current year provision as the closing. So balance CD on the debit side above the total and balance BD below the total on the credit side. So we have the value. Then select which value to be a total. So 14,000 is the highest value. So put 14,000 as a total for both sides. Then in order to make the credit side 14,000, so 14,000 minus 12,500, we have a balancing figure, 1,005. So this 1,005, okay, will be recorded as doubtful debts, meaning an increase, isn't it? So an increase means allowance of doubtful debts will be credit and doubtful debts will be debit. Increase, isn't it? So 1,005. Then remember, allowance for doubtful debts is liability concept, so we have to close the account. This one already closed already. And doubtful debts is an expenses, okay, because increase, isn't it? So we have to close off by posting to SPL. We credit doubtful debts and then we debit SPL. Okay, why we do this first? Because it's easier. Then you can do the prime entry. So the prime entry, now we refer from here. Okay, that is we allowance of doubtful debts will be credited and doubtful debts will be debited. So debit doubtful debts, credit allowance for doubtful debts. And in the financial statement, so we have SPL and SOFP. So how do we record? Okay. So in SPL, because we want to close off the expenses, okay. So you credited the doubtful debts. Now we debit the SPL, but debit in SPL in the statement form, so it will be considered as less. So doubtful debts, 1,005. And SOFP, okay, we have the liability concept, isn't it? Isn't the liability concept? But since it is related with the trade receivable, so we present it in the current asset together with the trade receivable. But then the symbol, trade receivable, less allowance for doubtful debts. Okay, we put in the first column, okay, to show the adjustment, 280,000 minus 14,000. Then the net amount only we put into the second column to list down all the current asset item. Okay, take note on all the heading. Must be statement of profit or loss for the year ended. Okay, because we are closing all the item inside this SPL, the revenue and the expenditure. And statement of financial position as at, okay, because we are carrying forward the balances, okay, for asset, equity, liability. Now, any question on this one?
So the AFDD also can short form.
It's good if you put full name.
I mean in the ledger.
Yeah. Yes.
Oh, okay.
I mean, in exam, unless you don't have time, okay, you can, no choice, you can put as AFDD. By right, we should not give marks on the short form, but then at the, the last minute, let's say, that is the only marks that you need to pass, which we give marks. So that's why you have to time yourself when you do. Okay. So let's say if 4 questions, so just limit yourself 20 minutes for each question. So after 20 minutes, if you cannot finish the question, move on to the next question, so that the last, you see, 20 minutes, you still have the time to finish off whatever that is left unanswered. Okay. Then this is where you decide you want to do short form or not. Just use short form if that is the case. Yeah. Okay. So next is decrease in the allowance of doubtful debts. This is how, it's a bit complicated. Decrease meaning the previous allowance of doubtful debts lesser than, the previous is higher than the current year allowance. So let's say 12,500 here, okay, lesser, isn't it? 14,000. Oh, sorry. This one, this is the first year just now, 12,500. Okay, and the current year is 14,000. So 14,000 is higher. I think the symbol is wrong. So we have increase of 1,005. But now, the previous year, this 14,000 now become previous year. So this is the current year, it's 13,000. So previous year more than the current year, 13,000. So meaning we have a decrease. So decrease, another method. How do we record? So this is the illustration. On 31st of December, Mr. Said decided to reduce allowance for doubtful debts to 13,000. Okay, the opening balance of allowance for doubtful debts is 14,000. So meaning this is your previous debts, allowance for doubtful debts. And trade receivable closing balance on 31st of December is 260,000. So that gives us the clue how to get the 13,000. So 5%, because we are maintaining the same percentage, 5% of 260,000, okay, is equivalent to 13,000. So that's why the allowance comparing with the previous, which is 14,000, lesser. This is lesser. So since the current year is lesser than the previous year, meaning definitely is a decrease. When, isn't it? Decrease. Previous year is 14,000. Now is 13,000. A decrease in provision, a decrease in allowance, isn't it? So that is how we identify. By identifying this, okay, the word decrease, it indicates this is revenue. Okay, so revenue is a credit item. So that indicates the double entry. We have to credit the full debts. Okay, so we use the technique that is we have to open the T account first, the general ledger, like what we did just now, and then record the opening and closing. Okay, so that's why in general ledger we put allowance for doubtful debts. Now we record the this one, the opening balance and closing balance. We record opening balance because this is liability, so it should be credit balance. And then previous year was 14,000, so put 14,000 here. And during the current year, okay, we already known the closing balance. So that's why we record closing balance 13,000, closing balance above the total. Huh? So this is credit, and then you see balance BD on the credit side. So this is credit balance. Okay. So after recording the opening and closing, so then we make the total line, single line on the top and double line underneath. So same goes with the same row, and then select which of this value that is higher value. So 14,000 is the higher value. So use 14,000 as a total for both sides. Now, the debit total, in order to make the debit total as 14,000, just now was credit total, isn't it? But now is debit total. To make it 14,000, the balancing figure is 1,000. So this 1,000 balancing figure, okay, will be posted to none other than doubtful debts. So that's why we put the particular here, doubtful debts. Meaning the heading of account, that is, we credit doubtful debts. Doubtful debts, we credit 1,000. And in doubtful debts account, okay, the particular, you put down AFDD, allowance for doubtful debts. So we have completed the double entry. So by knowing that doubtful debts is on the credit side, so automatically you know this is revenue concept, using revenue concept. So if it's revenue, then you have to close off, isn't it? Yeah. And for allowance of doubtful debts, so you just balance off. Already, this one done already. Okay, the heading, we just put doubtful debts. The rest, reduce liability, reduce allowance for doubtful debts. This is only explanation. Okay, only explanation. So it will reduce the allowance of doubtful debts. Huh? I mean, this is reduce allowance of doubtful debts. Why reduce? Because the opening higher than the closing. So resulting, this is the amount that will be treated using revenue concept. So that's why when we close off by debiting, yeah, and then debiting into SPL. Sorry, we debit the doubtful debts and we credit SPL. Okay, so credit SPL. Remember, we are preparing statement profit or loss in a statement form. So we don't see credit, but we just see add. Add is representing credit entry. Yeah? Okay, so that's why it's add and then income. So this one should be, the particular here should be doubtful debts. Huh? So it should be doubtful debts, DD. And then this is only a remark, decrease in allowance for doubtful debts. So you don't need this one. Huh? This one is just an explanation. Okay,
Oh, means
only
just write
this part.
doubtful debts on the part.
Yeah, just write down under add income, so doubtful debts, and the remark is decrease in allowance for doubtful debts, and put on the second column. Okay, the remark here is a change in allowance goes to SPL. Full amount of allowance goes to SOFP. Calculate the allowance. This is explanation only. Okay, and in SOFP, okay, it will be together with the trade receivable. So under current assets, so trade receivable put in the first column to do the adjustment first, and then less allowance for doubtful debts. Okay, take the closing balance. Okay, the closing balance is 13,000. This one. Okay, everything is closing balance. Eh? So take that. So minus. Then this is the net of the trade receivable. Then you put on the second column, because the second column is where you do the listing of all the current asset items. Right? Now, the prime entry, by right, we do the prime entry first, but then we found out that this is much more easier for you to understand. So that's why it's better you do this one first and then do the prime entry, which is, okay, allowance for doubtful debts and doubtful debts. You have to do, yeah.
Reduce reliability.
Come again?
Oh, I just see that the very long reduce reliability or reduce for doubtful debts.
This one, as what I've told you, this is an explanation. So you don't have to write all this. Kelvin, just write down this one, which I mark here. Doubtful debts. It is in a red color, and I highlighted with the gray color.
Okay.
Okay, the particular. Okay, so the entry, allowance of doubtful debts. Okay, look at this, allowance of doubtful debts, debit 1,000. And then doubtful debts, by referring to the figure, this is 1,000. So allowance of doubtful debts, 1,000. And then doubtful debts, 1,000 on the credit side, 1,000. Okay, just follow that. That is the journal entry, or sorry, the prime entry that we need to do. Okay, is that okay? Are you okay?
Okay.
Clara?
Okay.
Right, and then you see, when we do the journal, so make sure allowance of doubtful debts more on to the right, huh? And then the credited account more on the right hand side. So this differentiate which one is debited account, which one is credited account. So you need to state the debit account first. We debit allowance of doubtful debts, and we credit followed by the credit entry, doubtful debts, 1,000. Then put the remark, okay, decrease in allowance for doubtful debts. Okay, so this one done. Now, This is a detailed explanation on what is messy. Okay, never mind. Okay, detailed example. So trade receivable. This one is not in the question, not part of the question, but this is the formula that is given. So normally, how do we get allowance for doubtful debts? We will be given by the question the percentage, but we need to do the adjustment on the trade receivable first. Okay, that is if we have additional bad debts, like what we have here. Okay, you are given a trial balance of cocoa trading 31st of December. Okay, and then you have trade receivable, bad debts, allowance of doubtful debts. So meaning whatever that you have in the trial balance, yeah, 502,740, 7,120 for bad debts, this already completed double entry. Okay, meaning when they provide this bad debt 7,120 is already inside this 502,740. What do I mean? It's already inside. We already debited the bad debts, so that's why you have bad debts on the debit side here, and you have credited the trade receivable. I mean, it's already been recorded. So this one tells you. But normally in the exam, they don't give you this. But this is an explanation only. Can you understand? So whatever that you have in the trial balance, meaning we have completed the double entry. Because the reason, remember the trial balance, the definition is a tool to see whether have we observed the debit and credit entry. And the total debit and credit should be the same, isn't it? So that is the understanding. So whatever that inside the trial balance is already completed double entry. And you have the additional information. This one, not part of the question. This is stating to you, explaining to you, if you have open inventory in the trial balance, that is referring to last year figure. Okay, if you have inventory inside the trial balance, that is referring to opening inventory. Okay, now before the account will close, this is part of the question. The owner decided to write off an amount of 4,500 owing by Nano because the amount could not be recovered from him. Okay, this is not given. This is not part of the question, but only giving you how to do the calculation. I don't know why they go and include this. This is very messy. Okay. Are you following me? Can you understand?
Yeah.
Okay.
Right. So what you have in additional information, the double entry is not complete yet. So we have to record this. So that is, if you have an additional, so again, we debit bad debts, we credit trade receivable. So we have to minus later. That's why you see 502,740, you need to minus 4,500 because we don't see debit and credit at this point because everything is being calculated. So credit item, credit entry in a debit item. So it's reduction, isn't it? So that's why minus is representing crediting the asset here. 502,740 minus 4,005. And we have bad debts will be debited into this existing bad debts. So that one we plus. So completing double entry, we plus and then we minus here. Then you times with 3%, then you get allowance for doubtful debts. Full amount of current year to SOFP, change in allowance SPL, it will be in SPL. So this is not, again, this is not part of the question. Only informing you. Okay, but the question only is not which I didn't highlight. To write off an amount 4,500 owing by Nano because the amount could not be recovered from him. Okay, so how do you treat that amount? Okay, meaning you have to debit bad debts and credit trade receivable. So debit bad debts because this is a debit item. Yeah, so an increase of debit item. So you plus lah here. You plus 7,120. But for trade receivable, okay, you have to credit. So credit here is you minus, right? So the allowance for doubtful debts is 3% of trade receivable. So after you minus, you get the net amount of trade receivable, then you apply the 3%. Okay, 3% of trade receivable. So this one is only explanation. So it's not part of the question. Now, required, prepare the following journal entry, meaning the general journal. And then prepare the general ledger account. So we put trade receivable control account, we bad debts account, allowance for doubtful debts account, and extract statement profit or loss and statement of financial position. So your heading must put the extract in bracket. Now this is the solution. Okay, so just now we do the prime entry for number 1 and number 2. Okay, when we write off, so we debit bad debts. Okay, usual. Just remember, bad debts is an expenses, and then you credit trade receivable. So how do you calculate the bad debts? I mean, it's already been calculated for you for the first one, isn't it? So we put the figure given 4,005 debit bad debts and credit trade receivable. And then the second one, we provide the doubtful debts. Okay, how do we find? So this is decrease. How do we know it's decrease? Okay, first thing, remember this amount. You need to record the new written off bad debts. So 502, 740. So you need to record the bad debts, so minus 4,005. Okay, 4,005. So you have 498. So you have 498, 240, the net after recording. Okay, so 498, 240, then you times with the 3%, 0.03. So that resulting, okay, 14,947. So since we have involving decimal 0.20, okay, we can ignore that, but then since it's not more than 5, so remain 14,947. So compare this with the opening allowance of doubtful debt, 23,220. So a decrease, isn't it? So a decrease, immediately, you understand, a decrease is revenue. So that's why you can use that knowledge, okay, to do the entry immediately in the prime entry, okay, by crediting doubtful debts. And what is debited? The debited account, none other than allowance for doubtful debts, 8,273. So how to get 8,273? 14,947, this amount, yeah, okay, resulting from 3% of 498 times 240, okay, and minus this one, 23,200, 23,220. The previous allowance minus the existing one, we have 8,273. So that's how we get this. Are you okay with this? Can you understand?
Okay.
Class?
Okay.
So that is the amount. Then we record it in the prime entry. So by crediting doubtful debts, okay, because decrease, and then we debit AFDD. Then put the narrative decrease in AFDD from 23,220 to 14,947. So the difference is 8,273. Okay, so how do you get this one is the explanation. How do you get 14,947 lah? So record, okay, the new bad debts minus 4,005. Then from the prime entry, okay, we do the recording in the general ledger. So in the general ledger, remember, we have trade receivable control account, record the opening balance, record the opening balance, okay, those assets. Okay, and then your bad debts also, you can use the opening balance, yeah, as a particular, because it's from the trial balance, isn't it? So record, and doubtful debts we don't have it, and then allowance for doubtful debts, so which is credit balance. Record, yeah. This is from the trial balance, so record appropriately all the opening balance in the appropriate side. So remember, trade receivable is an asset, of course, is a debit item, so debit opening balance. Same goes with bad debts, is an expenses, so put as debit balance. But allowance for doubtful debts, like what I've said to you, using liability concept, so the opening balance must be on the credit side. Then record the transaction. That is the first number one. Okay, in the question, you have bad debts, new bad debts, isn't it? So new bad debts, that is, we open up bad debts account, already open. So do the double entry. We debit 4,005. Okay. We debit 4,005 and we credit 4,005 in the trade receivable because it's confirmed, isn't it? Confirmed cannot be collected. Okay, in trade receivable control account, so the particular you write down the name, the heading of the account that is being debited. So bad debts. In a bad debts account, in the particular, you write down the name or the heading of account that is being credited, trade receivable. Okay, then move on to the second transaction. So we provide the doubtful debts. So we have a decrease. So open up a doubtful debts account. Okay, and then since this is an income, so you credit, yeah, income, credit item. So credit 8,273 and we debit allowance of doubtful debts. Okay, that is the method. That is either way. You want to do like this, also can, or you open up allowance for doubtful debts like what we did just now. Okay, by recording, yeah, the opening balance and the closing balance. Okay, which is already been, known, isn't it? So we already calculated just now. Okay, and then find which is the highest figure, closing or the opening. Opening is higher, so use the opening balance as a total. 23,220 for both sides. Now, in order to make the debit total as 23,220, so we can find the balancing figure by deducting 23,220 minus 14,947. So we have 8,273. So meaning we debit allowance or doubtful debts. And what is the heading of credited account? So none other than doubtful debts. So that's how we do. Okay. So this one close. We already balance off. Now doubtful debts, we have to close off by posting, by debiting the doubtful debts, and we credit into SPL. So bad debts also, we have to close off. Okay, take the total amount and we close off by posting to SPL. Okay, then we do the extract. Financial statement. So we have statement profit or loss. So since this is, I said, income concept, so it will be, okay, we complete the double entry when they debited the revenue account, and now we are completing credit entry. But then, okay, credit entry is represented as add. So add other income. And again, like what I've said to you, this one should be doubtful debts. The name of the account should be doubtful debts. The remark, okay, decrease in allowance for doubtful debts. That is the remark. Okay, and we also have to record the expenditure. So this one no need to write. Only less expenditure. So this no need to write. Increase in allowance of doubtful debts. No need. Okay, so we have first thing bad debts, and in bracket, okay, you have to show your working. That is, in the trial balance we have 7,120. Okay, we plus with the first additional information 4,005. This is showing the recording lah. Okay, we have debited bad debts and we have credited the trade receivable. Okay, so resulting 11,620. Okay, this one no need to write. This is only explanation. Now, in this one also explanation only. So in SOFP, so under current asset, so you only state trade receivable. So you don't need to state this one. No need. This is only explaining. So we put trade receivable 498 240, and then allowance for doubtful debts, we take the closing one. We take the closing. So this one no need to state. This is an explanation on it. Okay. So 498,240 minus 14,947. So the net trade receivable, then we put 483,293. Okay, this one also no need to write down. This is only explaining to you. So that's why it's look messy. Okay. Class, are you following? Can you understand?
The bad debt, is it recorded in the SOFP?
No, because bad debts is an expenses.
Oh, okay.
We record like this also.
Hmm?
In this table. Oh.
Yeah, this one, okay, trade receivable, we record here the net after all the bad debts, 498. Okay, in the trial balance, this is the amount, isn't it? 502,740. So you minus with the additional information number one, then put that amount here, 498,240. Is that what you're asking? What your question was, Huh?
No, I mean that's
Yeah.
do we fill in like a table when we answer? We need to put a table there, and then we list down the things, the information, and then
Oh, you mean the bad debts?
yeah,
Oh,
the
yeah.
depths.
Yeah. You can do that also. Showing the working, you means. Yeah. Okay. Showing the working, of course, you put here in bracket, put down 502,740, then you minus 4,500. Then,
The need we need to write down the working.
yeah,
The,
because the working sometimes they given marks, sometimes they're not. So I'm just afraid that it will be given marks. So uh, there's nothing to lose. You just write down.
okay.
Okay. What else?
I
Can
think
we
nothing.
just finish off this one? I need to discuss the accounting concept.
Okay.
Is it okay?
Okay.
We
Okay.
just continue. Yeah. We stop at the neutrality, isn't it? Is it?
Forgot already.
Yeah. You forgot already. Okay. We are talking about neutrality. This one, consistency, of course, you know what is consistency, meaning if we have used the method, okay, the same method will be used to the same item, okay, so that the result, okay, the profit is comparable. Similar accounting policy must be used in preparing, reporting the similar item in the financial statement from one period to another period. Like depreciation. Okay, we have two methods, isn't it? One is straight line and the other one is reducing balance method. So if we have used a straight line, so we have to be consistent. Next year also, we have to use the same method, straight line. Okay, because if we keep changing next year, first year we use straight line, and then second year we use reducing balance method. So the amount of expenses is different. So let's say that is the only expenses we have. Your profit will be varies from one year to another year. So just because of the method is different. So therefore it doesn't comparable. The profit that you get is not comparable from one year to another year. So that's why we must use consistency concept in the accounting. Okay. Neutrality. So neutrality is talking about the information, the value of the information. The value of the information is material if omission or misstatement would influence the economic decision of the users. Economic decision meaning whether they want to invest, whether they want to buy, whether they want to continue with operation. That is what they call economic decision. So if part of the information okay was not disclosed, so but if it's being disclosed is different decision, then meaning that information is material. So materiality is depending on the size and the nature of the item. So we look at these two factors, size and nature. So some, okay, like calculator can be used more than 1 year, but by nature, of course, it should be accounted for as non-current asset, capital expenditure. But then, okay, the size is very small, isn't it? The value of a calculator is only like 50 ringgit, 70 ringgit, so very small, so immaterial. So uh, it is written off as an expenses rather than as a capital expenditure. Because if we record it as capital expenditure, we need to provide the depreciation like what we learn just now every year, every month. If it's, I mean, we need to close off the account on monthly basis, isn't it? So it's very troublesome. So that's why neutrality is depending on the size and on the nature of the item. So each material item should be presented separately. Okay, material item only will be presented separately. So those item that is not material, so they aggregated together with other similar immaterial item. Just like motor vehicle, why we don't have car account, bicycle account, we don't have motorcycle account, van account, lorry account, because of materiality also. So because of the size and the nature, so that's why we aggregated meaning we accumulate into one account and become one type of expenses or one type of accounts. Okay, so like water and electricity, table and chair, salary and wages, why they are combined together? Okay, because of the neutrality concept. Now next one is objectivity. Objectivity is a concept which is when we provide accounting information in the financial statement, it must be factual occurrence. Factual occurrence meaning source document. It must be supported with source document. Yeah, factual. Factual meaning it really incurred, it really happened. So the information that is included in accounting record must be verifiable. So that is factual, verifiable proof of fact, not based on subjectivity. Verifiable meaning it is supported with all the supporting documents. Okay, you have the proof, you have the fact, you have all the details in regard with that transaction. So that is being objective. Factual occurrence, not subjectivity. So the opposite objectivity is subjectivity, meaning you use your judgment to decide how much is the amount. So it's not factual. The amount or the detail are not verifiable because you don't have the source document. You don't have the proof. Okay. Now next one is substance over form. Substance over form. Look at the word, each of the words. Substance over form. Substance is referring to the item in question. Over form meaning the item, the actual fact of that item. Yeah. Transaction and other event must be accounted for and presented in accordance with the substance and economic reality and not merely the legal form. So this is the accounting concept. When we record the item in financial statement, okay, we record based on the substance, economic reality, meaning the physical of the asset, and who is using it must be economic reality, meaning based on the actual reality. So not on the legal form. Legal form is who is owning, who should be owning that particular asset. Just like a car on hire purchase. You know hire purchase, sewa beli. So it's not legally owned by the business. Let's say if you have 10 years, okay, hire purchase agreement. So those 10 years, I mean the payment, as long as you have not settled the last payment of your hire purchase, that car do not belong to the business. Legally, it still belong to the bank. So who should record the car as an asset in the statement of financial position? That is the question here. But since we have this concept, substance over form, so it gives us the guideline. Legally, the bank is the owner of the car, but in substance, the car is used daily by the hirer. The hirer can use the car however she or he likes. Therefore, the car could be shown as an asset in the hirer statement of financial position. So we follow the substance. Where is the location of the substance? So the substance is overpower the legal form. Okay. So the amount owing to the bank for this car will also shown separately as liability in the same statement of financial position. So remember the accounting equation, if increase in asset, so there should be increase in liability. So that's why if we record this motor vehicle in hire purchase, so we record as an asset, but on the other side in the liability also, we have to record liability. Yeah. Loan, motor vehicle loan. Okay. So that explains why those assets that is still under the banks, owned by the bank, we record as an asset because the accounting concept substance over form guide us how do we do the recording. Okay, that is the reality. Yeah, the physical asset, where is it located? Okay, it is located and used by the business on daily basis. So the substance over the legal form. Okay, so the car would be shown as an asset and the amount owing will be shown as a liability. Okay, that is substance over form. Can you understand the substance over form?
Oh, yeah.
Okay.
Yeah.
Okay. Now the next concept is realization. Realization, meaning revenue and profit, can only be taken into account when realization has occurred. So that is the concept. Realization only occurred, okay, when we have several criteria, okay, determined with reasonable certainty, that is by referring to this criteria. Okay, the first one, the good or the service are provided or delivered to the buyer, meaning we already delivered to the buyer. And the buyer accept the liability, meaning agrees with the amount owing to pay for the good or the services. And the monetary value of the good or service has been established. Because when you hand over the invoice to him, a credit sales, and he agree, he go and sign. So meaning the amount is already stated in the invoice, isn't it? So the monetary value have been established. And the buyer will be in a situation to be able to pay the good or the service. So these are the condition or the criteria, okay, when we use realization. So as we have done this, then meaning that revenue is already being realized. Like for instance, an order received from a customer for delivery of good next month will only be realized as revenue when goods are finally delivered, accepted by the customer next month. Okay, like receiving 3 months rental income, which include 2 months rental deposit, will realize revenue if only 1 month, because the 2 months deposit are not yet realized as revenue. So remember, this one is receiving 3 months. So 2 months is for deposit and 1 month is for the actual rental. So we, in accounting, we only record the 1 month as an income, but the other 2 months we don't record as an income. Instead, we record as a deposit. Okay, because of realization concept. Because we haven't earned the 2 months deposit yet. Okay, it's not been realized yet. You have the monetary value. Okay, but this one is not been delivered. Okay, is a deposit. And the third one, goods sold on consignment basis are not yet realized as revenue, because realization occurs only when the goods are sold to the final customer. good on consignment, the concept is different. Meaning they deliver the good to the customer, but then the customer, it is still owned by the seller until the customer signify that they are buying that good. Then it becomes sales. Okay, I will talk about that later again. Yeah, the consignment. All right. So we continue again on Thursday. Yeah. So that's all for today.
讲
OK
了
sir.
哦，sorry 啊，我要
Yeah.
现在要开
So
会
we
了，可
can
是
attend your
我拜拜好了，
tutorial.
我不要再讲，
Okay. Bye. You
没
may
有
leave the
，what's
class
that？
now.
OK sir, thank you.
All
What's
right.
that？啊，
Welcome.
你知道我问一题是他的问题，他的问我问题是10个，哇，我真的顶他不顺哦。我在想，我就跟他讲，我讲你一个星期才7个钟哦，你不能够 conduct class，你一定要 conduct class 吗？对，然后我就跟他讲哦，我讲 Janice 带2个 subject 啦，是我叫 Janice 做事，人家没有问的，人家也没有问有没有酸浆，人家对啊，就说人家肯帮是不用问这样多，你知道吗？哇，吓死我哦，跟你讲啊。How's your test preparation? Okay, no problem. So eventually, all right, here. All right. Oh, okay. So how's your test preparation? Can you hear me? Okay, maybe. Yeah. Actually, first 3 chapter, if you have a very good basic, yeah, then it should be all right. Not so difficult. I don't know. I haven't seen the question yet. So, yeah. Yeah, I think if you have done the tutorial, it should be all right. Oh, Kevin, you got one answer I haven't marked. Okay. Let me start recording first, then you can start. Today we're going to do tutorial 6, which is what? Non-current assets, right? Talking about depreciation. Yeah, and before that, I have to know some theory. Yeah, have to know some theory. The theory like what capital expenditure and revenue expenditure, correct? Yeah. What's the difference between capital expenditure and revenue expenditure? And then what is depreciation? Why provide depreciation? How many methods of depreciation? How many methods of depreciation have you learned? How many methods?
2.
2, right? Yeah. One is straight line and reducing balance method. Yes. So these are the common two. So which one is easier? Which one is easier?
The straight line.
Straight line is easier, right? Net book value also okay, just that have to actually my computer today work like a turtle so slow. Don't know what happened. So slow. Okay. Right. So this is your tutorial question. You can see my screen, right? Yeah, I think or else I have to turn off my camera. I think the line is not that good, right? Let's take see, not presenting some more. Okay, better turn off my camera like that. Okay. So now it's presenting. Okay, turn off. See, no point to on the camera because I don't think the line is not that good, right? Mhm. Okay, turn off already. Right, now this is your question. And then for this chapter, of course, we can test both to the theory and the calculation. Yeah, calculation wise, there are certain rules that we remember and must know how to do the double entry. All right, so the question here is that ask you to describe capital expenditure. All right, this one, capital expenditure. Capital expenditure, compatibility. Capital expenditure. What's the difference between capital expenditure and revenue expenditure? So in short, right? Okay, in short, it's basically we are saying that capital expenditure is you buy something that more expensive and you supposed to use it in the business, not for resale. Yeah, and you can use for more than 1 year. That is capital expenditure. Revenue expenditure is like you pay for expenses, like you pay for electricity bill, telephone bill, your rental, which is you only maybe you paid monthly or it's only for a period of time. Yeah, so normally it's within 1 year, so it's revenue expenditure. So you must know how to differentiate. If you don't know how to differentiate, then later on you can't actually calculate what is the cost of the asset. Then if your cost of asset is wrong, then later on your depreciation, depreciation amount also wrong. Yeah. So that's why you must know how to differentiate between capital expenditure and revenue expenditure. And then what is depreciation? Yeah. Why calculate depreciation? Right. Okay. So if I show you the answer, of course, this is the answer. Right. Okay. So capital expenditure is because spend money on buying or acquiring non-current assets. So basically, you're buying non-current asset where you actually increase the value of the asset that you already have. Either you buy a totally new one or you increase the value of the asset that you already have. So you say existing. So this asset that you bought, right? Okay, for your business, for you to use day to day, yeah, and your intention is not for resale, so not intended for resale. Then capital expenditure involve expenses to increase the value of the existing. Yeah, so basically you want to increase the function of the existing current non-current asset that you have. Yeah, so that the non-current asset that you already have become more efficient and more effective, right? So capital expenditure include, yeah, it will be including any the expenditure will include how you bring the asset to the current location and the condition. Like give you a very good example. Like for example, you go to you say, yeah, now weather very hot lah. Yeah, my room no aircon, so I want to install an aircon. Now, when you want to install an aircon, right, you go to the electrical shop, you buy this aircon, you bring home, but you need somebody to install for you, right? Correct or not? Okay, so let's say right? Let's say you need to you buy and then you bring home, but you need somebody to install. So the installation cost of this aircon actually part of the cost of the asset. Yeah, part of the cost of the asset. So meaning, let's say you buy this aircon for 1,000 ringgit. Let's say installation is 200. So if I ask you, when you want to calculate depreciation, how much do you use to calculate your depreciation amount? How much? Is it only 1,000 or 1,200?
1,200.
Yes, it's 1,200. So then you need to include the 200 installation. So you see, right, if you don't install, are you able to use the aircon? Cannot, isn't it? Yeah. So that's why you see this word here. Yeah, make sure the cost of the asset must include okay, the cost that you bring your asset that you actually already buy, yeah, put at the right location and at the right condition. So that's why capital expenditure should be capitalized and depreciated all its useful life. So this is capital expenditure, yeah, the characteristic. How about revenue? Revenue is actually expenses that you incur day to day, running the day-to-day business. Yeah, it is not to increase the value of non-current assets. Yeah, this one, right, it won't increase any of your non-current asset. No, it's actually for you to run your business. Like you pay rental, you pay electricity bill, you pay a telephone bill. So revenue expenditure is charged as an expense in the SOPL in the year it is incurred. Okay, yeah, in the year it's incurred. So basically, we only recognize like 12 months. Yeah, all right. Okay, now what is depreciation? Depreciation is actually, okay, why do we have depreciation? Because of matching concept. Yeah, because of matching concept. So what is matching again? Matching is so that we are able to find uh, profit, correct? Yeah. So meaning we should match the revenue and the expenses, correct? So that we are able to find the profit. So depreciation is the allocation or sharing of the cost of a non-current asset over a few years. Yeah, useful life. For example, if you think that this particular car can use for 20 years, so you divide it by 20 years. So when I say divided by 20 years, this is actually a straight line method, meaning your depreciation amount is the same every year, correct? So this is done so that cost of non-current asset is matched with the revenue. See, that's why we say it's a matching. Yeah, that's why we say it's actually matching. It's done for the cost of the non-current asset is matched with the revenue of the few years that have benefited from the usage. So you see, you use the delivery van to help you to actually, gain your sales, right? But at the same time, this delivery van, will it incur any expenses? Yes, like you need to depreciation. Delivery van, the more you use, the older it becomes, so the function is not as good. Correct? Yeah. So meaning at the end of the day, the value of this delivery van actually drop. Right. Yeah. So that's why what makes the value of delivery van drop is actually the depreciation. Yeah. So now depreciation is an estimation. It's an estimation, meaning do we pay in cash for depreciation? Are we paying in cash for depreciation? Do you pay?
No.
No, yeah, we don't pay. So there's no actual cash involved when you have depreciation. Yeah. So, but depreciation is charged as an expense, but there's no cash involved, right? There's no cash involved. Okay. So we don't pay. Yeah, we don't pay. It is only an estimation, right? Okay, we don't pay anything. So the amount of depreciation to be charged is an estimate. Yeah, we only estimate, right? Estimate, and the common methods of depreciation are straight line. Yeah. So there are two methods, right? Like just now, right? You all said you have learned two methods. So one is straight line, one is reducing balance method. Okay, revaluation is not in your syllabus. Revaluation is for advanced level, yeah. So the most common methods are the straight line and the reducing balance method, yeah, which is actually correct, right? Okay, now, so question 2, the most common method are the straight line and reducing balance method, right? So the question 2 actually asks, what is the two most common method? So the two most common method is straight line and reducing, yeah, okay, straight line and reducing, right? So Straight line and reducing. Okay, so straight line, how do you explain straight line? Yeah, how do you explain straight line? Common methods. Okay, straight line is basically the amount of depreciation is the same from year one until the asset is fully depreciated. So yeah, the value of the asset is actually the same, right? So the cost of the non-current asset are spread over its useful life, and an equal amount of depreciation is charged to the SOPM. Yeah, every year is the same, huh? Every year is the okay. So this is your formula. Yeah, this is actually your formula. Now, straight line actually they are actually not only using this formula. Can straight line? Can I use a percentage? Can I say 10%? Can I use a straight line as in percentage or not? Let's say 10%. Now, 10% is equivalent to 10 years. Do you agree? You know why I said 10% equivalent to 10 years? You agree or not? 10%
Why?
equivalent to 10 years. Why? Okay, now, so I let you know why, yeah? Okay. Right. 10 years. Oh, okay. I should have this now. So this is actually one method lah. I'll use this one. So if you see, if you according to this formula is acquisition cost. Yeah, your cost of your asset minus scrap value divided by estimated useful life. But another way is I can also use percentage. Now, in terms of percentage, it would be, let's say I say 10%. 10% is equivalent to 10 years. Why I say like that? Okay, now you see, right? How do you get 10%? 10% means in total, we say 100%, right? 100%, if we say 10% is actually divided, 100% divided by 10%. So isn't it 10? So it's 10 years, right? Okay, so now, so if I say 20%, 20% is how many years? 20% equivalent to how many years?
5.
Yes, 5 years. Understand? Right? So for straight line, we can use percentage as well, or we use this formula. Yeah, all right, straight line. So straight line, the characteristic is every year, the amount of depreciation is the same, okay? It's the same. Now, how about reducing balance method? Reducing balance method is, reducing balance method definitely use a percentage. It is definitely a percentage. But for reducing balance method, you cannot say 10% is 10 years. It doesn't work that way. It only straight line. So for reducing balance method, it says it's a fixed percentage. For depreciation, is deducted from the cost in the first year. Okay, at the beginning, in the first year, either whether you use straight line or reducing, is the same. You get the same number. But from year 2 onwards, it's not the same. Why? Because reducing balance methods, okay, except for year 1, from year 2 onwards, we always use net book value. You always take net book value time a percentage. Okay, this is your depreciation. Yeah, it's your depreciation amount. It's always net book value. Okay, you must use net book value time a percentage. This is then you get the depreciation. So you see, what is net book value? What is net book value? Net book value is your cost minus depreciation, right? Equal to net book value. Right? Yeah, this is for year 1, first year. Now, if you have, let's say after some years, it will be cost minus accumulated depreciation, then equal to net book value. So what do you mean by accumulated depreciation? Meaning cost is always the same, costs do not change, always the same. But accumulated depreciation, you see the word accumulate, meaning year 1 plus year 2. Let's say if you are in year 3, it's year 1 plus year 2, right? If you are in year 4, your accumulated depreciation is year 1 plus year 2 plus year 3. So meaning your accumulated depreciation value is going up, it's getting more and more. But your net book value is your net book value, the amount is actually getting smaller. So if you use reducing balance method, our depreciation amount is getting smaller every year. As the time goes by, your depreciation amount is getting smaller. Can? But for straight line, your depreciation amount is the same every year. Let's say 10 years, your depreciation amount is the same. But for reducing, your depreciation value is getting smaller and smaller every year. All right? Okay, so it's a fixed percentage of depreciation deducted from the cost of the first year. And at the, okay, year one is based on cost. But from year two onwards, you have to use net book value. Okay, so then you must know what is net book value. So net book value is here, your formula. All right? Okay, so in the following years, the fixed percentage is applied on the net book value. So meaning after deducting previous year's depreciation charges. So a different amount of depreciation is charged every year. So under reducing balance method, your depreciation amount is not the same every year. All right. Okay. Depreciation is an expense. Yep. Depreciation is actually as an expense. So to be asked, oh, what's the difference between depreciation and accumulated depreciation, right? Yeah. Yeah. Okay. Now for this one, what is the difference between depreciation and accumulated depreciation? Now, for depreciation, and this is accumulated, right? Depreciation is basically an expenses lah. Okay, this is an expenses. How about accumulated depreciation? Is it an expenses? Depreciation is an expense, so it will be actually as part of your one of the items under your expenses list lah. Right? Not correct? Okay. Now, but how about accumulated depreciation? Accumulated depreciation is basically okay. If I draw this T account for you, right? Okay, yeah. If I show you the T account now, depreciation is like this. Depreciation very simple. Depreciation, you put an amount here, and this one you put accumulated depreciation. Then at the end of the year, you actually pause to SOPL, right? Okay, this account closed already. Now, how about accumulated? Oh, accumulated is not like this. Oh, accumulated depreciation is actually okay. Let's say now you're in year two lah. Huh? So meaning you have your year one, right? Okay, so what you do is you have a BD here. Okay, this amount. Yeah, and then during the year, okay, this is you brought down from last year, and then during the year you have depreciation. Okay, depreciation. Okay, then at the end of the year, you must close it. Like this. Yeah. So this is accumulated depreciation. Can you see the difference? So accumulated depreciation, do you put this, you see, is a BD and CD. So then you brought down to the following year. Yeah. All right. But you can see the double entry, you know. You see? Can you see the double entry? So you can see the double entry here, you see? This account and this account. Right? So the double entry is between depreciation account and accumulated depreciation account. Yeah. All right. So we look at the theory here. It says accumulated depreciation is the total of all depreciation that have been charged. So your accumulated depreciation account, the amount is getting bigger and bigger over years. Yeah, it's getting bigger since non-current asset was acquired up to date. So it is recorded as a credit item in the ledger. See, credit item, isn't it? Credit item. Yes, right. It's a credit item. Right? So you see, your balance BD is on the credit side, right? So it's a credit item. Yeah, and then yeah, it's a credit items, and then yeah, so it's a credit items in the ledger, right? And the balance is carried forward. So you have balance CDBD, and accumulated depreciation is net off from the cost of the non-current asset to arrive net book value. Yeah. So meaning, so basically, if I ask you, so yeah, it's actually talking about this. Actually talking about this formula. Yeah. Isn't it correct? So if you look at this sentence here. Yeah. Correct. This sentence, accumulated depreciation is net off from the cost of the non-current asset to arrive at the net book value in X of FP. You're talking about this sentence. Yeah, talking about this sentence, right? So please note that the cost of the non-current asset and accumulated depreciation of the same asset are recorded in difference account. Yeah, okay. Please note that the cost of the non-current asset and accumulated is same recorded. Yeah, actually they are not the same account. So if you want to do depreciation, basically you need to have two accounts. One is the asset account, another one is accumulated depreciation. And of course, the other one, the third one will be depreciation account. Yeah, depreciation account. All right. Okay, so these are the basic for depreciation, this chapter that you must know. Okay, now look at question 3. Question 3. So tell me what is your answer. All right, true or false? This is to test whether you understand the chapter or not. So the first one, there are 5 here. So the first one, as a business has an accumulated depreciation account of 4,000 for a particular non-current asset, it means the business has accumulated or set aside this amount for this amount of cash for replacement later. Is it true or false?
Hmm. False.
Accumulated depreciation account 4,000. Yeah. So meaning we have meaning we set aside cash for replacement later. Not really, right? No, I don't think so. But I think the answer is wrong. Answer put true. Actually, it's false. Yeah, we are not setting aside an amount to replace. No. Yeah, okay, no. We are not setting aside an amount to replace asset. Actually, I don't think so. Okay. Now, how about B? Depreciation is the fall in value of non-current asset. Is it? Depreciation.
Yeah.
When we
Yeah.
have depreciation, is it the fall in value of the asset? Yes. Yes. Yeah. Because the more you use, the function of the asset become declining, right? Yeah. Okay. Part C. So B is true, right? Okay. Right. So this one, A is false, B is true. How about C? The straight line method is the depreciation method where decreasing amount of depreciation are being charged to the SOPL over the years. Straight line, okay, if you use straight line. Yeah, if you use straight line, the depreciation amount, is it decreasing amount that we charge to SOPL?
False.
Yeah, false. Is it decreasing? Straight line method, your depreciation amount, is it decreasing? Straight line method, right? Your depreciation amount should be?
The same.
Yes, should be the same every year. Yeah, should be the same every year. Okay, how about the fourth one? Net book value is the estimated value of non-current asset after deducting accumulated depreciation. True or not? So you say your net book value equal to your cost lah, your asset cost minus accumulated depreciation. Correct or not?
Correct.
Yes, correct. Yeah, correct. Just now I show you the formula right there. Okay, now last one. Capital expenditure is incurred when a business spends money to buy or increase the value of non-current asset. Is it correct? You spend money to buy or to increase the value of the non-current asset. True or false?
Yes.
Yes. Yeah. Answer is true. Okay. Yes. Right. Yes. True. Okay. Now, question 4 is quite long though. Right. Now, question 4, are you able to understand the question? Okay. Question 4 is a very good question. If you are able to understand the whole question 4, I believe this chapter you're able to master. So you see, machinery account is to test how do you calculate the cost of the machine. So the first thing that you need to do, how do you calculate the cost of the machine? So it says here, Brian operates a candy factory in Rawang. Yeah. So the machine in his factory are purchased overseas. On 1st Jan 2012, he purchased a machine from Korea costing 120,000. Okay, only the machine itself, 120,000. Then the machine was delivered to Malaysia on freight. Of course, from Korea to Malaysia, So the transportation is 3,000. and the fetch insurance is 1,002. Okay, was borne by Brian. So when the machine landed in Malaysia, Brian paid custom duty of 3,000. Yeah, okay. So now you can see you have 120,000, then you pay for the transportation cost, then you pay for the insurance, then you pay for the custom duty, right? Okay, what else? Let's see. And Brian hired an engineer to install the machine, all right, within the factory. Then the engineer told Brian that in the event Brian wishes to dismantle the machine in the future, it will cost him 700. Yeah, dismantle. So let's say next time if you want to move, so you need to dismantle, then you need to pay 700. Then after the installation was completed, the engineer billed him 1,000. So you see, the engineer helped you to do the installation. Do you need to pay the engineer? Yes. So the engineer actually charged 1,000, right? Okay. So then he said, Brian plans to use the machine for 6 years. So 6 years is a useful life, yeah. So every year the machine would be maintained at a cost of 350. Maintenance cost is 350. Now in year 7, so we only want to use for 6 years. In year 7 still can use. No more. So in year 7, the machine will be dismantled and sold off as scrap for 5,000. Yeah. So in year 7, okay, we don't want to really sell it off, yeah, as scrap, 5,000. When we sell, we said we'll get 5,000 at the end of the useful life. So for every of his asset, Brian adopts a policy to make full year depreciation in the year of purchase. So meaning, I don't care which month I buy, as long as in this year it's a full year depreciation. So meaning you don't have to calculate. Sometimes when you do depreciation, you need to calculate, like let's say I only use it for half a year, so my depreciation is only 50%. But when you see this sentence, meaning whether in this particular year, whether you use it only for 3 months, or you use it for 4 months, or you use it for 8 months, it is considered as full year depreciation. Yeah. So meaning you don't have to pro rata. You don't have to pro rata into 3 months, 5 months, or 6 months. All right. Okay. So part A asks calculate cost of machine. So how much is your cost of machine? What do you think? How much is your cost of machine? Then I said, compute the annual depreciation for the years ended 1, 2, 1, 3, 1, 4, 1, 5, 1, 6, 1, 7. So 1, 2, 3, 4, 5, 6, 6 years. Yeah, correct. So we start in 1st Jan to 6 years. So you need to calculate the depreciation for 6 years, okay, using 2 different methods, straight line and reducing. Now reducing must be in percentage. So the question gives you 42%. So you have to use this one, must use this one. Straight line is actually 6 years. All right, 6 years. Okay, and then part C, after you have this answer, right? Okay, so please prepare this account: machinery account, depreciation account, accumulated depreciation account, SOPL, SOFT. But I only want 1, 4, 1, 5, and 1, 6, yeah. So make sure you know how to read your question, right? Make sure you know how to read your question. Okay, so how much is the cost of the machine? How much is the cost of the machine? Yeah. Anyone?
Uh,
How much is the cost of the machine? How do you calculate the cost of the machine?
Not
Yeah.
not the initial cost, or you still need to account for the depreciation. No.
Yeah, can say like that. No. Cost of the machine first. Don't talk about depreciation first. Yeah. 6. Yeah. Cost of the machine first. Don't talk about the depreciation first. So, okay, if I want to calculate, right, okay, cost of machine. So in exam, you can do something like this. Right. So now we are talking about machine, right? Okay, cost of machine. So you can put like this. So you say, what is your purchase cost? Okay, purchase cost. The question say, okay, put RM. Purchase cost is 120, like that. Anything else that you need to add? Anything else that you need to add?
the transportation, the
Okay.
insurance.
Yep, transportation. Right. Okay, transportation, which is 3,000, right? Okay, how about insurance? Yeah, all these you should include, because of this machine, that's why you need to include this thing. So you must include as part of the cost of the machine. So insurance is 1,000 too. Okay. Anything else that we need to include? Custom duty, right? Correct? Okay. Custom duty, which is another 3,000. Any more? Any more that we need to include?
Uh,
The maintenance of the car.
Maintenance, I don't think so. Because maintenance, you need to do it every year. Maintenance is to maintain the machine. So that one should be a yearly expenses. Yeah. Okay. Beside transportation, insurance, custom duty. Any more? Two more items.
The installation.
Okay. Installation, good. Okay. Installation is 1,000. Any more? One more.
They said it says that they want to dismantle it in the future, but
Mm.
this right now is not the future. You still count as you should count the
Yes.
dismantling.
Yeah, we have to include the dismantle cost now. Okay, so the dismantle, which is 700. So this is your total cost of your machine. So your answer is this number. So meaning, this is your part A, right? So when you do the next part, right, part B, the question asks what is your depreciation, right? So you should use this amount to calculate your depreciation.
Miss, why the dismantle also included?
Yeah, then dismantle you need to include because later on you have to include as part of the cost of the machine because it's already fixed at the end of 6 years you have to dismantle, meaning you have to pay, so you have to carry as part of your cost.
So even though the machine like changed location but haven't sold yet,
Yeah, still have to include, yes.
still. Oh, okay.
Okay, so now if I want to calculate depreciation, what is your formula? Okay, you see, right? This question did tell you this question did tell you the scrap value, right? Correct. At the end, in year 7, they actually sell as scrap. So if you see the scrap value, then you need to use the formula. You see the formula in your notes. Scrap value divided by number of useful life. Yeah. So you have to use this one. You have to use this formula. Yeah, you have to use this formula. So you need to recognize what the information given by the question. So since the question gives you scrap value, then you must use this formula. So if you use this formula, okay, so what is your working then? So your working would be how much your cost? Right, this is your cost, right? Minus scrap value is 5,000. Divided by useful life is 6. So this is going to be your answer lah, like this. Okay, this is your answer. My number is not. Yeah, okay, so this is your answer, 6, right? Okay, so in this case, how much is your depreciation per year? Oops. How much is your depreciation per year? So your depreciation would be berapa? So you use your calculator lah. So when you do accounting, you must have calculator with you lah always. So divided by 6. So is right. Yes. So this is your number. So this is the answer that you want. Yeah. So you must determine. Okay. You must determine how much is the cost of the machine. Right. So you have to include those expenditure that spent on this machine. All these are important. You see, transportation is to bring to the right location, right? Insurance is also make sure it's at the right condition. Custom duty, this one is from the government, I have to pay. Installation is at the right condition and at the right location so that you can use it, right? Dismantle is actually, this one is at the end, okay, at the end, yeah, this one, no choice, you have it, yeah. You have to include the dismantle because you already know that at the end you have to dismantle. You definitely need to incur the cost. So all this add up, okay, become your cost. Right? So like scrap value is actually given in the question. No? Yeah, scrap value actually given in the question. And useful life also you know. So read your question carefully. Then you should be able to find the answer. Okay, read your question carefully. Okay, can? Yeah. So this is depreciation. But there's a fact that I want to tell you, right? From my experience, a lot of students, when it comes to depreciation, right, they are very blur. Don't know how to do. Yeah, seriously, I also don't know why. When it comes to depreciation, always if the test involves depreciation, right? Yeah, a lot. I mean about it could be about 40% of students can't do. Yeah. In fact, is it so difficult? No, I don't think so. I don't think it's so difficult. Lah. Okay, then the next part is we need to calculate depreciation every year for 6 years, right? Okay, so this one we can actually, I'm going to do it in this way. So I put year. Okay, every year, every year. So meaning start from 20, right? And then 1, 3, okay. 3, 4, 5, 6 years until 2017. Okay, this one actually not supposed to be like this now. So we have to make some adjustment. Put number, no thousand separator. Okay, yeah, like this, right? Okay, then you're gonna put here oh actually okay, let me do this one. Then so here will be 2014, 2015. Oh, okay. Okay. Right. 2016 and 2017. Okay, like this, yeah. Right. Okay, and this two, put it this. No thousand separator. Right. Now, so I'll put like this. Okay, so I'm going to do both method at the same time. Yeah, all right, okay. Now, so in 2012, how much is the cost that you start with? How much the cost that you start with?
Uh, one to add 900.
1289. Okay, right? Okay, so we have two method lah, straight line reducing balance method. So we start with this number, correct? Yes. So yeah, okay, we do one by one. So we do straight line first. Now for straight line, we already calculated how much is the depreciation, right? 20,650. So meaning for the depreciation, it's actually the same. Okay, yeah, it's actually the same every year. Oh, I get, I should do, yeah. I think I show you reducing balance method first, yeah, because of the, right, okay, like this. So the depreciation, now, for reducing balance method, the question says 42%, right? 42% on the, okay, this is your first year. First year is on the cost. Year one is on the cost. So your cost is this number, right? Okay, times 42%, right? So this is your first year. Okay, 2012 is our first year, right? Because we bought this machine at the beginning of the year. So we only provide depreciation at the end of the year, right? So you see here is year 1, year 2, year 3, year 4, year 5, and year 6, correct? We are going to do 6 years, right? Okay, so So this one you need to calculate. So how much is this number? Okay, so did I use formula? Times 0.42, right? Okay, so I get this number. All right? Okay, now then I need to get the net book value, isn't it? Right? So meaning this is actually a negative number. So this one minus this one. So this is the net book value, correct? Yes, this is the net book value. Right? So first year my depreciation is this much. So after depreciation, this is my net book value. So I bring forward to the next year, 2013. And then in 2013, I need to prepare depreciation again. Correct? Okay, now tell me, when I do depreciation, how much do I put here? The one that I highlighted. What is the number here? What is the number here?
The 746 762.
Correct. Yeah, correct. Yes, 74. Yeah, so you should use this number. Net book value, huh? Because this is reducing balance method. So reducing balance method basically we use net book value. So this is the net book value. Okay. So in this case, then okay. I use formula, huh? Okay. Then I get this number again, right? Okay. Yeah. Then I look for my net book value again. Is that correct? Yeah. Yeah. So this is my depreciation, then my net book value. So my net book value, this one minus, okay, my year 2 depreciation. So this is my, I bring forward to year 3, this is my net book value. Okay, then, yeah, depreciation again, right? Okay, so how much do I need? How much do I put here?
The 433,621.
Yeah, okay, 433,362, right? Times 42%. Yeah, that is. Okay, so okay, so I take this one times 42%, 0.42. Okay, right. Okay, can you see that? Then I'm going to look for my net book value again. Yeah, so like this. Okay. So this is the net book value. Yeah, okay. Now, do you see that the depreciation value is getting smaller and smaller, right? Correct? 25150 times 42%. Yeah, okay. All right. So here, okay, again, take this one times 0.42. So I get this number, and then I'll take this, my net book value minus okay, net book value minus this one. Yeah, all right. Then this will be our net book value, right? Okay, and depreciation 14587 times 0.42. Okay, yeah, right. So again, take this times 0.42. Okay, and then I need to find my net book value. This one minus this one. Right. Okay. Now, now already 5 years. Okay. The last year, final year. Okay, so it will be 6127 times 42%. Okay. So, okay. 0.42 is also 42% now. Right. So,
Miss, isn't it 8460 times 42?
oh yeah. Okay. Now, the wrong number because I typed the depreciation.
It's easy to make mistake at this.
This one, yeah, this one you have to, after you finish, you better double check. If you don't double check, this will be a problem. But you see, if you use reducing balance method, it can go on, it can go on. Not like straight line. Straight line after 6 is equal to 0 already, but this one it won't equal to 0. Yeah, it won't equal to 0. Okay, but we only asked to do for 6 years. So okay, up to here already. Okay, finish. Yep, so we do up to here. So done. Okay. Yeah, okay. So finish like this. So this is reducing balance method. Okay, yeah, reducing balance method. Now, so if I highlight the, okay, so see, this is a depreciation. So do you see that your depreciation amount is getting smaller and smaller, isn't it? Right? Obviously, yeah. See, every year is actually smaller and smaller. Oops. Right? Isn't it smaller and smaller?
Yeah.
So this is a characteristic of reducing balance method. Yeah. Okay, so actually I should draw a line here. I have to put the line. Okay, yeah, this one I have to draw a line. Yeah, it's like if you draw a line, then you can see better. Then you know, then you can actually check whether there's any mistake or not. Yeah, okay, like this. All right, so depreciation is all the yellow one. Now, how about straight line? Yeah, straight line. Okay, straight line is easier. You see, we already calculated the yearly depreciation and straight line. Every year is the same. Okay, then we put like this. Yeah, right. Okay, so I can actually copy the formula lah. All right. Okay, then yeah. Okay, then I put another 650. Right. Okay, then here I copy the formula again. And then here I put, yeah. So for straight line, it's easier, right? Every year is the same. Okay, then here I copy. Okay, then here put like this. Every year the depreciation is the same. So you calculate one time that you can use and use, not like not like the reducing balance method. And see, isn't it equal to 0? Right? Yeah. Okay. Just copy. I want that line. Oh, got 5,000. Oh, now 5,000 is a scrap value. Remember, they have a scrap value of 5,000, right? 5,000 is your scrap value. So this 5,000 is actually a scrap value. Remember, you have a scrap value 5,000.
Oh, yeah.
Yeah. So you see, at the end, it will equal to a scrap value. Yeah, it will not fully depreciated. It won't equal to 0. That's why I am so excited. I forgot this is 25. Okay, yeah. So you can see, so straight line is easier. It's actually easier because you calculate one time, then every year you use the same number, and at the end of your useful life, okay, you must be able to see what is your scrap value. And your scrap value will come out. Okay, the scrap value will come out. Right? So you can see here reducing and your what your reducing balance method, yeah, reducing and straight line. So you see this 5,000 is actually this, okay, yeah, it's actually the scrap value. All right, it's actually the scrap value. So if you use straight line at the end is equal to the scrap value, okay, then your answer is correct. Okay, your answer is actually correct. Okay, now we move on. So the question say what? We need to prepare machinery account, depreciation, accumulated depreciation, right? Okay, and now see the question tests your understanding. The question does not start from year 1. The question asks you to prepare year 3 or year 3, year 4, and year 5. Year 3, year 2, and year 5. Okay, so let's say I can draw one T, and then later on I'm going to use it. So I'm going to keep okay, I'm going to keep one account here, right? Oh, yeah, my office PC is very slow. That's why I'm not used to it. If I'm at home, then it'll be very fast. Okay, so you cannot work too fast in the office. Yeah, right. So we have how many accounts we need to prepare? Oh, 3 lah. Okay, so 3 only. Okay, now so we start with machine. Okay, now machine account. How much is your machine account? And the question say we start from 2014. Yeah, 2014. Right? Okay, 2014. Okay, 2014. Then we actually don't mind the what because we put thousands of people. Right. So we start from 2014. So how do you start? What is your opening balance? Debit side or credit side? Your opening
Uh,
balance is
deb-
debit side, credit side.
Debit.
debit.
Yes, debit side, which is correct. Okay. Now, so my opening balance is on the debit side. So what do you put? Put January first, right? This is
Right.
um. The problem with the thousand separator. Yeah. Okay. This one I think I have to use a normal number already, or else it's very annoying. No thousand separator. Not red, not in red. Okay, yeah, like this. So this would be Jan first, correct? Hey, why is still like this? Oh, why is it funny?
Oh, yeah, mine also like that.
Yeah, well, yeah, this is very annoying. But yeah, okay. You know why I long time I never face this problem because when I teach a higher level, I don't put the date. But for you, I need to let you see the date. Okay, let's say it's a general. Okay, let's see, can or not. Okay, yeah, better. So this one is balance. Balance up. Balance.
BD.
Okay, good. Yep, balance BD. So balance BD, how much? Our machinery from the first day until we actually retire the machine, the cost is the same, right? Yeah. Okay. So it's this number lah. Okay, then now we need to do 3 years. So since there's no increase, okay, no decrease, right? Okay, so we do like this all, right? Okay, then this is balance CD law. Okay, 128,900, correct? Yeah. Okay, then this one you close the account now. Okay, like this. So we close off. Okay. Then we bring forward, right? Then we bring forward. Okay, then this is 2015 already, right? Correct? Yeah. In another year, then we have balance the BD again. Okay, no change. Okay, this one actually no change. So you just do like this. Right, no change. Huh? Okay, and balance. So you just bring forward, carry it down, brought down, carry it down, brought down. Okay, so yeah, okay, like this. Okay, then we go to year 6, 2016. Okay, so yeah, it's like this lah. Then it's 2016, 2015. So this is December 31st. Okay, and put here, and the amount is still the same. Okay, so your answer is like this. So assume we don't have new purchase, there's no disposal. Okay, so this is how your answer looks like. All right, okay, machine account for according to the question now. So we only do 3 years, 14, 15, 16. Okay, of course, this one, if you want to further, you put 2017 if you can. So here you put first Jan. Okay, balance BD 128,900. Yeah, all right. Okay, done. Okay, so this part actually done. Yeah, all right. And this one I need to okay, put it to the face right. So, wonderful. Okay, so machine account looks like this. Oh, this one machine account look like this, huh? Aiyo. It cannot look too far. Not too far, we become like this. Okay. Okay, right. Now, so we finished machine. The next one is depreciation. Now, depreciation, the double entry is between okay, you see depreciation account. Okay, now, so let's say I do year by year. Okay, I'll let you see the accumulated depreciation. Now, see what is the difference? One is accumulated depreciation is your amount is getting bigger and bigger, and you have balance CBDB. Depreciation is actually we actually close it every year. Okay, we close it every year, right? Every year. Okay, so anyway, we start from 20 2014, right? Okay, 2014. Yeah, okay, now in 2014, how much is your depreciation? So your depreciation account is an expense. So expense meaning we start from the debit side, right? Correct? Debit side. Okay, so we provide depreciation in 2014, which is actually our third year. Yeah, third year. We provide depreciation normally at the end of the year. So we put 31st December. Okay, so what do you put here at the particular?
Hmm.
What do you write here? Accumulated, okay. So I use short form. It's actually this one. It's actually this account. Right? Okay, it's actually this account. Now, the question say we use what? We use reducing balance method, right? Reducing balance method. Okay, so you go and find in your year 3, how much is your depreciation year 3? Year 3, this one is it. How much is your depreciation year 3?
18,212.
Yeah, 18,212. Okay, so you put here lah. 18,212. Okay.
Need to put for every year. Or
Yeah,
just
every
1
year.
year. Oh,
Every year. No, we do a 2014 first. Okay. So this one like this. Okay. Now, how about this account? Accumulated depreciation. We start from debit or credit? We start from debit or
Credit.
credit? Okay. For this account, we start from credit, right? Okay. So meaning we start from credit. So meaning okay. So we start from credit. So meaning we have to put our opening, right? Correct? Yeah. Okay. Then this one is our balance BD, right? Okay. How much is your balance BD? If you start from 2014, meaning how much is your balance BD? Anyone?
Start from 2013.
So you see, okay, how much is your balance BD? Now we start from here, right? Right. We are doing these three years, Isn't it correct? Yeah. We are doing these 3 years, right? So your accumulated depreciation is how much? How much is your
85,000.
85,000
538.
at 5538? Yeah. Okay. How do I get at 5538? It's actually your
add,
year 1.
or add up every year before it.
Yes.
Oh,
Your year 1 plus your year 2. Right. Your year 1 plus your year 2. So okay. Now you look at your year 1. Your year 1 berapa? Year 1 is this one. Year 2 this one. Is that correct? Because now we start from year 3. So you need to accumulate year 1 and year 2. Correct or not? Yes? Understand? So this example is very, very useful. So when you do revision, you must look at this example. So if year 1 plus year 2, okay, the depreciation of year 1 plus year 2. All right? Okay, then now in the current year, okay, at the end of the year, we have depreciation, right? Right, we have depreciation. I think I make it a little bit smaller so that you can see 2 accounts together. Okay, now you see depreciation here is debit, right? Doing double entry. We're going to do a debit. So this one will come to here. So here is your depreciation. Yeah, the amount from your depreciation account 18212. Okay. All right. All right. Yeah. So this is year 1 plus year 2. This is your year 3 depreciation. Okay. And then so in total, how much now? So in total, okay, you get this number. All right. Okay. So here. Okay, so at the end of year 3, okay, at the end of year 3, so 31st December, when we want to finalize our account at the end of the year, so this will be balance CD. Yeah. Okay. So how much is the balance CD? Okay, it's actually 103750. Correct. Yeah, so this one is 103750. Yeah. So, like this. And then you brought forward, right? You brought forward to 2015. Okay. 1st Jan again. right? First Jan, so this one is the balance BD and 103754, correct? Yeah, and okay, then you're going to do your year 4. So you see, this is your year 3, right? Correct? Yeah, this is your year 3 depreciation. Okay, so this is your year 3 depreciation. Okay, now we want to find year 4 depreciation. Okay, so you see your balance BD, this is what? Year 1 plus 2 plus 3. Okay, right. So tell me, how much is your, okay, let me close this one first. This one happened that. Right, okay, so this one to SOPL. Okay, we touch to statement of profit or loss. 18212, yeah, okay. So this one, I just put double line, okay, double line, yeah, right. Okay, now we go to 2015. So now this 2015 ready, right? Okay, so 2015. So here 2015, then we at the end of the year, another year of depreciation. Okay, so how much is now? Again, the double entry is here. Yeah. So, right. Okay. So the same thing, double entry is here. So how much is your year 4? Okay, let's see. How much is year 4? How much is your year 4? Year 4 depreciation.
18212.
No.
Oh,
Year 4. Year
10,000.
4. Then here, this is year 4. Okay. Year 4, 10563, right? 10563. Okay. So we put here. So year 4 is 10563. Right? Okay, so again, the double entry to accumulated depreciation. Right? Okay, so here will be 10563. Right? Yes, yeah, 10563. And then yeah, so you can see again, you can see the double entry, right? Right, so this one, okay, so it's actually, yeah, right. And then we are going to calculate the total. So this is our total, and we are going to bring forward. Yeah, okay, so at the end of the year, then we close our account again. Okay, so this is a balance CD. Okay, so this is 114313. Yeah, right. Okay, 114313. Okay, then we're going to brought forward to 2016 and January 1st, which is balance BD. Yeah, right. 114313. Okay, right. And then, oops, this one, make it, no, this one, make it general. Okay. Yeah, right. So this is January 1st, right? Okay, then another year. Okay, now we see now here this one is 1 plus 2 plus 3, right? And plus 4. Fair enough. Okay, now we want to include the year 5. Right? Okay, so how much is our year 5? Okay, at the end of the year. Yeah, okay, at the end of the year, then we have depreciation again. Okay, so now how much is our depreciation for year 2016? How much?
6,127.
Yeah, 6127. Okay, oops. 6127, right? Okay, so here we put 6127. Okay, again, double entry. Oh, this one. Okay, close this answer. SOPL 10563. Right, okay. Right, okay, then 416. Okay, 31st December. Right, so double entry. So from accumulated depreciation, how much will it be? 627. 6127, right? Okay, so again, you can see, okay, so you double, this one, right? Okay, like this, yeah, right? All right, so we close this account. So we are only asked to do 1415 and 16. Okay, done already. So 31st December and SOPL 6127. So you see, every depreciation is yearly. So every year we charge to our SOPL to calculate our profit. Yeah, all right. Okay. Then for this one, add them up. All right. Okay. Got this. Okay. So 2016. And balance CD. Okay. 1, 2. Correct. Yes. Oh. All right. Okay. Okay. Then of course you can bring down to 2017. And January 1st. So this one is your balance. Okay, balance BD 120440. Okay, done. Yeah. Okay. Is it very difficult? Can or not? Like I told you, this is a very good example. So when you do revision, you should refer to this. So you must know how to calculate how many years, which year you start from. All right? Yeah. Very, very good example, this one. All right. So then the next part is so you need to do section B. Section B only one question, right? Okay. So you must practice on section B. Oh, got 2 questions. But question 2, okay lah. Got 3 questions. Okay lah. The question 1 is a bit long. 2 and 3 should be all right. Should be quite short. Okay, now we still have 2 more parts, SOPL and SOFP. Now, so the question say, so now we already prepare all this, right? Then we need to prepare SOPL and SOFP. Okay, I do it here. Okay, I start from here. I put the SOPL, so I use short form. SOPL for the year. For the year ended. Okay, for the year ended. Okay, now I'm not going to put the year because I'm going to do 3 years together. Yeah, so I put RM. Okay, RM and RM. Then I put 2014, 2015, and 2016. Right, okay, yeah, 3 years. And here I put depreciation. Okay, so tell me, how much is your, like this? Actually, the format should be like this. Yeah, so tell me, how much is your depreciation for 1415 and 16? Oh, berapa? Actually, you already have the number, just that you need to put it. You just have to put it in. Yeah. So 2014 is how much? So you can get the number from here, isn't it? Correct? So your 2014 is 18212. 2015 is 10, right? Your 2016 is 6127. Right? This is in your statement of profit or loss. Every year, how much is your depreciation that you charge to your statement of profit or loss? Okay, so your number is like this. Now, so statement of profit and loss is very short. Okay, the next one is SOFP, financial position, asset. Okay, so this one should be 31st December. This one I can actually put 31st December. Okay, but year will be okay like this. So for this, right, so I can copy this one. Okay, like this, then draw a line. Right, okay. Now, so in your in SOFP, what you need to do is you need to put in the format will be like this. You put non-current asset. Yeah. So this, like I say, this format you have to memorize. Yeah. Non-current asset. Okay. Then we have machine. Correct. Yeah. I say assume you only have one. We only have one asset. Okay. Machinery. Okay. Then we have then we need to less accumulated depreciation. right? And then it will give us our net book value. Okay. Net book value like this. Okay, so for 2014, how much is your machinery? Your machinery. So, okay, then you refer to your machinery account. All the same, isn't it? Correct? Yeah, you refer to your machinery account. All the same, right? Okay. So, all the same. So, 128,900. Right? Okay, so it's the same. Okay, now, how about accumulated depreciation? Accumulated depreciation, please look at the left-hand side. Now, okay, for 2014, how much is your accumulated depreciation? Which number do you put into your SOFP?
103,750.
Yes, very good. Okay, 103,754. Okay, right. So now, what is what in SOFP? In SOFP, we always put the balance CD. Your balance CD will appear in your SOFP. Right? Okay. So if 2014 is this one, then 2015 you know already. 2016 you also know. Right? Yeah. Okay. And then net book value is machinery minus, right? See here got less. You see the word less, isn't it? Correct? So this one minus this one, right? Cost minus accumulated equal to net book value. So I set the formula. Okay. Yeah. So all right. Okay, done. So you can cross check with your just now your part B here. Is your net book value correct? Betul got your number. Should be correct lah, huh? Yeah, all right. Okay. Okay, so this is your question number 4. This is your question.
Can combine 3 years in one SOP.
Can.
Oh, okay.
So this is the format that I give you. So later on, when you do your section B, okay, so please do your section B. Yeah, section B, all 3 questions you have to do, especially question 1 to practice. See whether you understand or not. Yeah. But okay, for section B, I think if you want to do exactly the same like your question 4 also can, like prepare the asset account, prepare the accumulated account. I think they did ask you. Oh yeah, it's the same actually. Your section B question 1 is the answer that needed is actually the same as your question 4. It's the same. So go and practice. You will learn from here. So you use this question 4 as a as a guide. Then you can actually do from there. Okay. So do you have any question? I'm not going to go on so because I think you have to do your work better. Yeah. Because we have almost done anyway. Almost time's up already. Okay, so you can see balance CV goes to SOFP. Yeah, all the balance CV actually goes to SOFP. Oh, this is not the one. Right? Okay, all the balance CV goes to SOFP. Yeah, right. So do you have any question to ask? Any part that you're not sure? Yeah.
Very short of this soft statement of financial position.
Yeah, of course. Because we only do non-current asset now. Anyway, you can't do equity, you can't do current asset because there's no information, right? No information given, so you cannot do lah.
I just used to it. I just used to seeing very long.
No. It depends on the question. Depends on the question. Anyway, no information given, you also cannot do. So during exam, don't panic. Okay. So because we only want to test you, we only want you to do the asset part only. Like this. Yeah. All right. So I believe if you follow, you should be able to do that. And I also believe that your lecturers also have a full set of question and answer, right? So no need to worry. Just need to do some revision, before your test or exam. Then you should be fine. And section B, go and do. So yeah, later on I need to mark Kevin's answer. Right?
Okay.
So your answer, okay? So you have done any answer, you just hand in, then I'll mark for you. Then you know, yeah, then you know what is your problem. Very important to do question. So any question you want to ask? Any part you don't understand? Yeah. So
No.
you're able to see the double entry, right? You see depreciation and accumulated depreciation, yeah, the double entry, isn't it?
Yeah.
Okay, huh? So right. So depreciation, is it difficult?
Not so difficult. I think the first few still more difficult for
Yeah,
me.
not difficult actually. But my experience I also don't know why 40% of students cannot do it. Yeah. Seriously,
Some
maybe they
maybe hard to keep track, I think.
yeah, have to keep track. Yes, have to be careful year by year. So you see, like you see this question, you see, all of a sudden they ask you to start from year 3. So that's why the best thing is you always start from year 1, you know, especially for reducing balance method. You always start from year 1. Yeah, always start from year 1. Now, for straight line, you can start from any month. It's fine, isn't it? It's easy to calculate the reducing balance, the accumulated, right? Isn't it correct? Yeah.
Yeah.
Mm. Okay. Now, if let's say, if you see, this one is, okay, let's say we do, we do something extra. This one is reducing balance method lah. Okay, how about we do extra like this? This is for straight line. Okay, tell me, what is your number?
20 something.
Right, huh?
Right.
Is it all the same? Is it every year the same?
Right.
Straight line is every year the same.
Yeah, okay. So straight line is every year the same, huh? Okay. Okay, very good. Now, how about this one? Okay, this one I also copy lah, huh? Okay, now we do the straight line, huh? Okay. Yeah. Put here. Yeah. Okay, now, so for straight line, machinery, this one is the same now, okay? Whether you use straight line or reducing, the cost is the same now. What happened? Okay, how about accumulated depreciation? Berapa this one?
20650 times 3.
Times 3?
So it's 61.
Yeah,
950.
20650 times 3, correct? So it's 61,950 lah.
Right.
Okay, how about this one? How about in 2015?
Add to 600.
And this one?
103250.
Yes. Okay. And then you go and check whether is it I can use this. It's not sum. It should be this one minus two. Okay. Then you check just on your table, betul like that, remember. Okay? Yeah. Right? Now, is it for straight line, right? Okay, let's say we do this one. Let's do this one. Yeah. This one reducing, right? Okay, let's do straight line. Okay, now if we do straight line, so you see this number is all the number not the same, right? Okay. Okay, now we know that this is year 3, right? Okay, this is actually year 3. So how much is the balance BB?
61.
So meaning if you want to calculate this number, you take this number times 2, correct? Year 1 and year 2 times 2 lor.
Oh, yeah.
It's a bit easier. It's easier, right? Yeah. So for straight line, for straight line, basically without this working also you can get your number, right? But reducing, if you don't do this working, you can get the number. A bit difficult, right?
Yeah.
So this is the thing. So for straight line, it's actually very easy. You if you know how many years, okay, so you just find so this one, like, okay, and then here is this one, correct? Then you put here, okay, then you come here, then it's 61950, right? 61950, okay. So is it correct, 61950? Or correct, huh? 61950, okay, then you continue. So here, 61950, okay, then you put another year, so same, right? Okay, then this is right, okay, then this is right, okay, and here at 26, right, okay, this one, no, yeah, like this. Correct. So you see, straight line is much easier actually. Reducing, you got to be careful. So you better do the working, better do the working, okay, better do the working. Mm. Okay, can? Right, so can
Yeah.
see, yeah.
Yeah.
Okay, so can then continue with section B. About your tests. Yeah, you have any question, then I think we do revision what, on Thursday? Or shouldn't have any problem.
Okay.
You have to let me know lah. Yeah, better you ask question because normally we need to cover the tutorial, right? So you better let me know. You ask question is actually faster. All right then. Okay, so I'll see you then. All right, let
Okay, miss.
me.
Thank you, miss.
Okay, no problem. Bye bye. Take care.